Okay, I think we may still have some people trickling in, but we should probably get started for the sake of time.
Okay, that sounds great.
Okay, hello everybody and welcome. Thank you for joining us on this Monday morning. I know we had a last minute change moving from an in-person to a fully remote program, so I would like to extend an additional thank you for accommodating us. I know post-COVID we're all pretty used to changes like this, but it is appreciated nonetheless. My name is Nicole Faru. I'm a senior policy here at the Division of Financial Regulation, and I will be moderating today's discussion on the intersection of innovative technologies and green finance. This event is for the public. And so before we begin, I'd like to give a little background on the division, our innovation hubs, and why we chose the topic that we'll be exploring today. So the Division of Financial Regulation is part of the Department of Consumer and Business Services, which is Oregon's largest consumer protection and business regulatory agency. And at a basic level, we do exactly what our name would suggest. We oversee and regulate financial products, institutions, and services in the state of Oregon. We administer over 20 programs, which includes insurance, banking, credit unions, securities, money transmitters. I won't list all 20, but if you're curious, you can go check out our website. Day to day, what this looks like is we're issuing licenses, responding to complaints, conducting examinations, and if needed, pursuing enforcement actions against persons who violate the provisions of the statutes that we administer. We also do our best to pursue opportunities like this to engage in outreach and public education. Finally, as a division, we are also constantly assessing the regulatory framework that we work within and pursue changes to that framework when necessary. That is where my job comes in as a senior policy advisor. I advise the division on internal policies and practices, rulemaking, and legislation, both those proposals that we initiate and that are initiated externally but would affect our programs. In addition to my regular duties, I was recently appointed Innovation Liaison, which is why I'm here in front of you today. So the position of Innovation Liaison was created several years ago and was designed to really be a single point of contact within the division where stakeholders can work with regulators to improve the state's ability to regulate novel financial products. What this looks like is I connect with fintech firms, learn more about their business models and how they're currently regulated under our framework. Then we review those regulatory requirements and try to identify areas where our framework needs to be modernized to keep up with changes in technology and industry. It is not an easy task, to say the least. But as part of that effort, we do periodically hold innovation hubs, conversations that bring together regulators, industry members, and academic experts to discuss specific areas where innovation is rapid and regulation is difficult. This year, we chose to explore the topic, can innovative technologies make green finance better? So why did we choose this topic? Well, over the last few decades, there has been a push for so-called green finance. Citizens, regulators, legislators, industry members have really, searched for ways that finance can be used to create a more sustainable world. And we have seen dozens of products pop up that claim to do just that, provide financial returns, and promote sustainability. The thing is that in recent years, these products and services have come under some increased scrutiny. Things like greenwashing scandals, questions about exactly what return on investment you're getting, not to mention a host of regulatory issues, have really raised the question of whether green finance will be able to do all that it promised or whether it will start to fade into the background as more of a fad. Now enter innovative technologies. As technology evolves, it has the potential to offer solutions to the problems facing green finance, and these are use cases that we really want to encourage. At the same time, technologies like AI and blockchain introduce risks into the systems that regulators have to grapple with. There are really no easy or obvious answers here, and that is precisely why we choose to have these conversations. So in order to explore these issues over the next couple hours, we have a great lineup for you. First, we're going to have a panel on the intersection of AI and green finance where our panelists will discuss potential use cases for AI in the realm of green finance, the regulatory concerns associated with those use cases, and the operational considerations that businesses of all sizes are struggling with as this technology becomes more mainstream. Following that will be a panel on the intersection of blockchain and green finance. There, our industry experts will discuss the potential use cases for blockchain to further sustainability goals, as well as the barriers facing those applications. And finally, we will have an executive chat between the Administrator of Oregon's Division of Financial Regulation and the Director of Washington's Department of Financial Institutions, where the two executives will discuss the challenges inherent in regulating green finance and innovative tech. So during the first two panels, time allowing, we will be taking questions from the audience. In fact, we will be encouraging them. So feel free to ask questions by using the Q&A function at the bottom of the screen rather than the chat function on the right-hand side. You are welcome to type questions at any time, but they won't be addressed until the end of each respective panel. So thank you for bearing with me through all of that information. And even though we're a few minutes early, it looks like we have all of our panelists up and ready to go. So I think we will dive right into our first panel on the intersection of AI and green finance. We are extremely fortunate to have three distinguished panelists with us today. So first, let me introduce Professor John Down. And Melissa, feel free to spotlight our panelists as they come on board. So John is a recognized thought leader in the field of AI, having spent much of the past 10 years thinking deeply about the exponential growth trajectory of AI capabilities. John evenly splits his time between his position as a University of Portland professor of entrepreneurship and AI and working with companies to responsibly leverage the power of AI through his consulting company, Gen AI Corporation. He has a PhD in business strategy from the University of Washington, an MBA from Harvard Business School, and an engineering degree from Oregon State University. Thank you for being here, John. Next, we have Josh Cole. Josh is the Director of Business Operations at Modernist Financial, a B Corporation wealth management firm based right here in Portland, Oregon, that helps people structure their wealth around their values. As AI becomes more prevalent, a key area of Josh's work is carefully considering AI integration and new technology solutions into the workplace. Previously, Josh founded and served as executive director of a nonprofit supporting Oregon's food, service, and agricultural workers in crisis. Josh received his undergraduate degree from the University of Oregon and his master's from the University of Southern California's Marshall School of Business. And last, but certainly not least, is Kirsten Anderson, who is a deputy director here at the Division of Financial Regulation. Kirsten joined the division roughly 25 years ago in 1999. I'd like to say she gave me those numbers. I did not offer them up myself. After a few years of practicing law, both for Oregon Legal Services and through AmeriCorps, then in private practice, she joined the division, and then following a number of different positions was appointed deputy administrator. Her portfolio includes oversight of sections that regulate our state chartered banks, credit unions, non-depository institutions, securities and insurance companies, as well as managing the division's operations section. In addition to her duties at the division, Kirsten is heavily involved in several multi-state organizations. I will not list them all here for the sake of time because they are impressive and numerous, but they are on the website if you want to take a look at all the things that she's involved with. So Kirsten, I think we will start with you. I just gave a rundown of your extremely long list of responsibilities, but maybe you can just briefly describe in more basic and concrete terms what you do at the division.
Sure. Good morning and welcome, everyone. I affectionately call myself the money deputy because I work with all of the programs that involve money. So our state chartered banks or state chartered credit unions are non-depository securities, and the company side of insurance, which looks at the financial solvency of the insurance carriers. We have another deputy here, Alex. He gets all of the other things that aren't money, but are incredibly important too. So our enforcement, our outreach, our consumer advocacy, our policy unit, and then handles the compliance side of insurance. So setting rates and forms, ensuring compliance with those. So I don't actually do any of the day-to-day work. I work with a bunch of incredibly talented people who handle the ins and outs of it. I work with the managers to answer complicated questions, to look at direction of their programs, things of that nature, and try and look out for the future and where we're going. So looking at things like, weighing in on policy decisions. So we get lots of really important information from the policy analysts that say, here's where we should go, here's what the law says, here's what it could say. And then we work with them to help understand what sorts of decisions we should be making to ensure the best safety and soundness for banks, credit unions, and protecting consumers. So that's a little bit about what I do. On the national side, as Nicole mentioned, I've been very active in working with other states on trying to be uniform in areas where we can be uniform, because that's better for business, it's better for consumers. Looking at supporting the programs that help us regulate, like for instance, on the non-depository side, we use a program called the Nationwide Multi-State Licensing System, otherwise known as NMLS. It's run by a board of directors. I'm on that board of directors. So it's a lot about policy and direction and keeping the states looking at things together and trying to find solutions that work, that we can implement on a uniform basis as much as possible, as well as use our scarce resources to the most effective way possible. So a lot of companies are licensed in multiple jurisdictions. Can we work together on exams? Can we do one exam instead of every state doing their own? Things of that nature.
So to say the least, you are very familiar with the full range of financial products and institutions here in Oregon. Since we're going to be talking about green finance, how would you define that? And I know that, some people have different opinions on exactly what that encompasses, but I'm curious about your thoughts.
So that is one of the issues, is that there's no like set definition of green finance. It's not like everybody says this is what it is. But broadly speaking, we're all in the same sort of area. So it's a financial product or service that's been created to ensure a better environmental outcome. So that's the definition we're going to use. It pretty much brings together everybody's, but again, there's not a universally accepted definition. Now, there are some great examples of what green finance is. So there are like products whose primary funding is for green projects, like those for renewable energy or pollution prevention, or even the sustainable use of natural resources and land. So funding for these projects can be in the form of like green investments, green loans, or green bonds. There's also less direct products that fall under the umbrella of green finance. These include things like green mortgages. These allow lenders to provide better terms for home purchasers of properties that have high environmental sustainability, or if the buyer agrees to invest in enhancing the environmental performance of the property. We have green credit cards. Those enable consumers to direct their expenditure towards green finance in order to have a more lasting impact on the environment every time they make a purchase. We have green banks. Those operate similarly to traditional banks, but they employ public funds to spur private investment in renewable energy and other environmentally friendly initiatives. And of course, can't forget insurance, because that's a big part of what we do here. We have green insurance products. These are insurance companies offering policies that incentivize environmentally responsible behaviors, such as discounts rates on premiums for hybrid or electric vehicle owners, or reduced rates for sustainable farming practices.
Yeah, I think that's a great overview. I feel like I have also seen pretty much a like quote unquote green version of any existing traditional financial product, which is just, kind of interesting as we move through this phase. But thank you for that overview. I think it's very helpful. I think we'll move to Josh. And again, I know I gave an introduction to you and your company, but I'm hoping you can just reiterate for the audience, maybe more of the nitty-gritty of what your company does and then what you specifically are responsible for.
Sure. Yeah. Thanks, Nicole. And thanks for having me and convening the panel. My role is Director of Business Operations at Modernist Financial. We're a B Corp, a boutique wealth management firm located in beautiful downtown Portland. We also have a social impact arm called Modernist University. And over the course of our business development, we have found that clients really choose to work with us because they feel an ethical obligation to positively impact their communities, the environments in which they live and work, really through their financial decisions. And so they have entrusted Modernist Financial to support them on that journey to structure their wealth around their values. And so one of the ways that I show up in my job working in operations is thinking about, in the context of this conversation, how to responsibly deploy novel technologies or artificial intelligence in service of our clients, while also thinking about ways that we could productively scale the business without risking any sort of compliance concerns.
Okay, thank you. I think that makes a lot of sense. Also love the hat painting in the background there. Was just noticing that as you came front and center. Okay, so Modernist was basically founded to help people structure their wealth around their values. And we obviously are here in beautiful green Oregon. So how much of an appetite have you seen for kind of environmentally sound investment options? And then how do you think about offering those to people in maybe a quote unquote safe way to make sure they're getting what they want?
It's a great question. And so if we look at the snapshot of 2020 to 2024, we've seen a really strong interest in that investment strategy from our clients, but also from prospects. And so Modernist, for example, had an annual growth rate of roughly 22% in AUM invested specifically in sustainability screens during that time period of 2020 to 2024. And so that looked like a 26% allocation to 58%. And so that's a significant increase in our AUM. And so that speaks from our perspective to the appetite here at home. And then to your question about how we're thinking about offering these options to people, at the same time that we've seen an investment in sustainability screens, we've also seen an increased need to really educate our clients about ESG strategies or about, quote, green finance as practitioners. And so it's been very important for us, again, as practitioners, to remain aware of the evolving landscape, the evolving regulatory environment. Again, as Kirsten said, there's really no universal definition of green finance. We tend not to use that internally at Modernist Financial. We tend to gravitate towards ESG, environmental, social, and corporate governance. And so the way that the products are offered to our clients, the way that they are discussed with our clients, folks often come to us just knowing that they want to invest in alignment with their values, and they need help understanding what that means. There's this old sort of money story that we've understood that have been told by traditional advisors that you can't do this, that clients should make as much money as possible and then give some of that away. And that's an old money story in the industry that takes some careful recalibration for clients who are coming in here. And so, Nicole, you spoke a little bit about the way that ESG has been politicized over the past several years. And despite all of that, we have found that ESG values-based decisions are a rapidly growing part of our business. There's far more evidence-based solutions to offer as the market improves and expands. These products tend to have longer track records now that can be benchmarked to indexes to understand return and volatility differences. And so a quick anecdote that I think might drive this home, my CEO, our boss, Georgia, when she launched the firm about 10 years ago, she says the terminology was often, terminology that she would use was a bit like organic. It was organic in the 70s. It's a bit expensive. It was unclear as to what you're buying, very hard to define. One person's definition of organic different from the next. But over the years, the industry evolved, and we've been able to add real evidence-based strategies to our offering. And so by evidence-based, I mean they support our investment philosophy. That looks like low-cost funds for global stock and bond asset classes, tax-efficient, broad market exposure. For example, our most popular portfolio focuses on reducing greenhouse gas emissions. And then there's also another offering for $2 million plus portfolios that are more tailored options for US holdings. Those are values tailored, direct indexing for US equity sleeves within an overall sustainability allocation. And just to drone just a second further to make, I think, the challenge clear is that really part of the job, as I mentioned above, is educating our clients. Clients need to understand the differences in return and volatility to benchmark indexes. And so this becomes one of the challenges is as an investor, we need to think critically about where we're investing, how as an investor do we make choices, and what currently available information from ratings agencies are we choosing. And so implementing these portfolio strategies isn't without obstacles for investors due to the complexity of the industry. We feel that we're currently operating in a fragmented regulatory environment, specifically for sustainability reporting, different mandates to report in different regions, different disclosure requirements for reporting companies, different levels of stakeholder engagement, right? The EU has the CSRD that mandates certain companies report. The SEC's proposed, but is yet to adopt sustainability reporting requirements for the US companies. And even within some of the ratings agencies, and I think Deputy Administrator Kirsten will talk about this, even within some of the ratings agencies, such as MSCI, Sustainalytics, those ratings agencies deploy different frameworks to assess ESG. They use different measurements, different weights. And so the information network becomes incredibly tangled and hard to understand as an investor, consumer, and a regulator.
Yeah, so I think what I'm hearing from you is it's mixed. We do have this appetite, the industry is getting better, but there's still a lot of challenges, especially with the regulatory framework. And I feel like we've seen that with a number of different industries where it's not that things were necessarily clearer or better in the past, but as they become more popular, the regulatory issues become more salient, and that may be what we're dealing with now. So Kirsten, Josh just talked a little bit about some of the regulatory issues, but what do you see as kind of the largest issues in the sector more generally?
Yeah, so regulatory, it's really hard. This is what we deal with all the time, and we're in this area particularly fragmented. And it's because there's no uniform standards that govern what constitutes an ESG investment or how to make proper disclosures so that companies can operate uniformly across borders. And here's the problem. This isn't something like the state of Oregon can fix on its own. As much as we try and look to see what are other states doing, how can we be uniform in this, it isn't even something that the states working together can solve because this is across borders of countries. So we have to figure out how do we make this work so that these things are the same, whether you're sitting here I happen to be in Salem, Oregon, or you're up in Vancouver, British Columbia, because we work very closely with our Canadian neighbors. So we need to look for ways to make these standards that, of what ESG investments are and how to make the proper disclosures for it, similar across countries, not just among our states. So that makes it a little bit tricky to work in because we're very used to working with our sister states, not so much with other countries, with maybe the exception of Canada, because we do work closely with them in NASA. So that is one of the tricky things about the regulatory scheme. There's other things that causes. So that trickles down to the customers who are actually investing in these. They have a bunch of uncertainties that come up in this area. It is a newer area when you look at the history of everything. So as was pointed out by Josh, we are getting to a place where there is more of a history that you can look at, but it's not as long as other places. So it is more difficult for investors to figure out things like what their return on investment are for these, because you don't have as long of a history to look back to as you might in other areas. And then unfortunately, there's been some studies that have shown that ESG funds tend to perform poorly compared to traditional funds. and that's gained a lot of traction in the news. Not sure whether or not that is in fact true, but that perception gets out there and that hurts the sector because, people don't understand or don't have these things that they can look at that maybe show a different outcome than that. There's another thing that's a little bit tricky when it comes to ESG, and that is, as Josh mentioned, it's not just looking at, how much money did I make, but there's benefits that aren't quantifiable when you're investing in green projects. So like in a traditional fund, it's like, how much money did I make? And that's my benefit. But when you're looking at ESG, it isn't just how much money you make, it's how much it's made things better. And so it's hard to sometimes understand the totality of the benefit that a person gets with an ESG investment, because you also have to quantify how much better is the environment because of what we have done. How much did it, if it, you're looking at something that reduces pollution or something like that, how much did it reduce the pollution? How much did it cool the temperatures in the cities versus if we hadn't done this? It's very complex. It's hard to put together. And so there isn't as much, it isn't as easy for a consumer to understand the full benefit of the investment that they've made when it's an ESG, because there are extra parts. There are also like hard things when it comes for like quantifying this for the private sector as well, because sometimes you want to see how far the capital has gone in your investments. It's much easier to do when you're not looking at the what's generated beyond just the dollar figure, even on other things. So and then on top of that, there's this problem with greenwashing where sometimes when they are trying to calculate the benefit of in the non-economic terms, but in the environmental terms, sometimes it gets exaggerated or misrepresented. And that can create some negative attention to this area and lessen consumer confidence. So it's, even though it might be tricky to calculate this, then if it gets calculated wrong, it ends up harming the efforts that people are making to advance in this field.
Yeah, thank you both for that rundown of the issues facing the sector. They are certainly very real and present. I think we'll bring Professor Down up now to see if AI can offer some solutions to some of the problems they just discussed. Before digging into potential use cases though, would you mind just giving a brief description of AI so that everyone is kind of on the same playing field?
Yeah, I think that is a good place to start. And thanks for inviting me to be part of this. This is interesting and I'm learning a lot. That's one thing with AI that I've been doing a lot of workshops, a lot of stuff on campus and then with other companies. And you just always learn so much because there's so much to kind of learn about it, sort of thing, right? And so, I think there are definitely ways that it can help, and there's probably some challenges that it can bring too that I'm sure we'll kind of get to as well. So, kind of at its basic definition, artificial intelligence is machine or computer intelligence that's capable of performing tasks that usually require human intelligence. And some people don't really like the term artificial intelligence. I kind of like it, just the way it does sort of set off against the human intelligence or biological intelligence, and sort of to think about some of the parallels. But yeah, just to talk a little bit about some of the characteristics of it. And, it is a tool. And in some ways, we're going to be talking about it as how can it be a tool to make green finance better. But it's not really a tool almost like any other tool, really, right? It's not a hammer and it's not a printing press and that kind of thing. And the things that make it different are things like it's able to perceive its environment. It can analyze data that we give it. It can learn from experience through reinforcement learning that you can give it rules. And there's a lot of different types or subfields of AI as well. Of course, generative AI with ChatGPT has been around for almost 2 years now. It'll be late November was when 2022, right, was when ChatGPT came out. But there's a lot of other AI. You can go back to when AlphaGo was able to beat the best human players and could beat previous computer versions or AI versions of Go playing just by it watching games, learning the rules, and then figuring out how to make, how to become the best player and beating all the other previous computer versions. So that's not necessarily the same sort of deep learning neural networks, but it's other types of machine learning with reinforcement learning that those systems were using. But also then AI, because it can learn, then it can adapt and change. So it's not something that stays constant necessarily, which again, as we sort of think about how do you regulate it, can be extra challenging. Let's see a few other things here too, that obviously it can do complex analyses, and that's something that we're going to be talking more about, how it may be able to do some of those kinds of functions in this green finance space. But it is creative. It can create new content, new ways of thinking about things, make decisions. It can also take actions, and that's another thing that kind of sets it apart from other tools as well, and solve problems. So, and a few other things, I guess, just to talk about a little bit as we're introducing it here is there's also, it's quickly becoming more capable in the physical world as well, right? With some of the advancements we've seen around humanoid robotics, especially they've been working on robotics for a long time and different types of robots and of course, autonomous driverless vehicles. But we've seen significant rapid advances there. There's the Oregon company that's based out of Corvallis called Agility Robotics that's building humanoid robots that Amazon is being deployed in. And I think they're setting up a factory in Salem actually to build their robots. And there's other types of physical manifestations of AI as well. We can think about drones, of course. And even I was thinking about sort of the Neuralink brain implants and things like that. So so it's going to become more and more visible or present in our physical world coming as well. And then another sort of comparison between artificial intelligence and human intelligence, of course, is thinking about the development of AI on an exponential scale versus the development of human intelligence on an evolutionary scale. And so it seems pretty clear that at some point in the fairly near future, we will have AI that goes beyond human level intelligence. And that brings a lot of new opportunities, but then also a lot of new questions and sort of uncertainty about how that's going to kind of unfold and what the future might look like. And we might get there possibly later in our discussion here today. And just one thing on this exponential growth, it's sometimes when we're in the middle of it, it may be a little bit difficult to see, but if you think about the compute behind the AI systems over the past 50 years, that compute has doubled every year. And that exponential growth is expected to continue. In fact, it's actually been a little bit more than doubling in the last 10 years. Jensen Huang, the founder and CEO of NVIDIA, which of course makes all the chips. He also has some interesting ties to Oregon. He went to Aloha High School and to Oregon State. But yeah, I saw him when he was at Oregon State and they were building a supercomputer down there with a lot of NVIDIA chips. And he was talking about the future. They expect in the next 10 years to maybe have the compute be another 1,000,000 times faster than what it is today. And anyway, if you double something every year for 10 years, you have 1,000 times what you started with. And if you do that for 40 years, you have 1,000,000,000,000 times. So even if the AI algorithms don't advance and things like that, it's expected that the compute will. And so, we just do have this incredible growth and capability that we're going to see over the coming years and decades. And a couple last things here to mention. One is sort of the black box nature of it as well, because we don't really understand exactly how AI comes up with the specific answers that it comes up with, responses. And so, there's some challenges here. I'm sure, Kristen, you have some thoughts about that too, in terms of regulation and that kind of thing. And then the last thing I was just going to mention is sort of thinking about this inverse relationship between the capability of the AI systems and the amount of guidance that's needed from human intervention kind of thing. So it's this inverse relationship, right? As the AI gets better and better, then there's less need to have kind of the human in the loop. And right now there are a lot of issues around performance of some types of AI, and we do need a lot of kind of human oversight. But it seems like as we're evolving going forward, we're always finding new AI applications as those are being released that are a little bit spotty in terms of their accuracy and capabilities when they're initially released. But then the ones that have been around for a little while, we put more and more faith in them because they've been refined and they are much more capable and need less sort of human oversight. So yeah, so I think that's another important thing to think about just in terms of this context of regulating. Yeah.
Yeah,
Green finance.
that's all very interesting. I think it's, we go to a lot of conferences as regulators and you hear a lot of definitions of AI, and it's one of those things where the base definition tends to stay the same, but the sub points that are emphasized and continue to do so. Okay, so drilling down maybe more on the granular, like you have a consulting company, say someone walked into you and was like, we want to create a better ESG fund, or having issues with return on investment. What would you tell them AI might be able to do for them?
Yeah, so, as I think about kind of general use cases and how AI could be leveraged in this space, there's sort of two kind of general categories, I would say. One is thinking about all the companies that maybe are getting started, or existing companies that are now trying to incorporate AI in their businesses that are environmentally focused companies. So AI is going to provide a lot of opportunities for companies to do things that are better for the environment. So it seems like in terms of the opportunity to invest in these kinds of companies, it should increase sort of the range of possible companies that are going to be out there doing kind of cool things. There were a couple of examples that sort of come to mind. One is a local company that I worked with a little bit, and they're a company that help other commercial companies with their water usage, and they provide some actual physical equipment and stuff to help with water usage, but then also monitoring the water usage data from some of these companies. And the companies they work with are generally ones that have like apartment buildings or senior living facilities or residence halls on university campuses, things like that. And what they find is that all the water usage data from all these companies, there's a lot of data that is generated, and they have been kind of by hand sort of thing, trying to analyze, when are there anomalies? And sometimes they catch them and sometimes they don't. And the anomalies can be due to equipment problems and things like that, or they can just be due to billing errors and things, which turn out to be quite prevalent in this particular space. But they're not the sort of things that the companies themselves have people dedicated enough to monitor all this data, unless it's something completely outrageous or whatever. And so they started using AI to analyze all this data, and were able to kind of quickly identify places where there could be questions raised. And then in many cases, they were able to go work with the water utilities serving some of their clients, and then get rebates for overcharges and things along those lines. So, so that was one example. Another example, there's a lot of agriculture examples where AI is able to help everything from watering to managing weeds and all that kind of stuff. And yeah, and I've heard of a number of examples there that seem to be working pretty well. So yeah, so those are kinds of some of the things that are going to create more opportunities for investment, it seems like, in companies that are going to help the environment as they leverage AI tools. And then the other place is all the different stakeholder companies in the green finance space. So, I was thinking about companies like Josh, your company, and regulators as well, the financing, the banks, green certification companies, the monitoring, and there's probably other types of companies as well. So those companies then thinking about the best way to try to leverage AI to improve the work that they're doing, their operations, the value provided to their clients. How do you sort of go about that? And so, you could think about, am I going to try to identify a use case that's going to really help solve a problem that we have? But the challenge there is it's difficult to sort of identify that use case if you don't have some reasonable familiarity with what AI can and can't do. And then also, how are you going to actually implement that use case? Are you going to try to build it on your own, or are you going to work with an outside company? Is that going to be a company that maybe has been a partner of yours in the past and now are adding AI to their offerings? You know, if they're a company that provide data analytics, now are they providing some new AI tools? You know, or is it a startup company in the kind of green fintech space kind of thing they're sort of built up based on some AI? So there's a lot of challenges there. And what I would suggest is that you want to start by upskilling kind of the people in the organization and giving some exposure to AI, and let everybody start to kind of experiment a little bit. And so, you know, in order to do that, there's some things you have to do, because that's not an easy thing to do as well. And so, you know, maybe that might be a good place to leave it for now, and see where we might want to go, or I could talk more about sort of how you might do that as well.
Yeah, I think that is a really good point, that there are certainly barriers, and it's going to look very, very different depending on exactly what organization you're dealing with and the resources they have at hand. But yeah, maybe you could talk more almost in hypothetical terms about, you know, what this technology could be capable of, assuming you maybe had the organizational expertise. Like if you had your ideal world, you had the experts, you had the resources, what would you be able to do?
Yeah, so, you know, the general kind of use cases, you know, that we've been talking about that seem to make a lot of sense are sort of summarizing a lot of data, analyzing a lot of data, and it could be financial data, or it could be, you know, Josh, you're having to deal with different kinds of regulations and things along those lines, you know. So some of the AI tools that are just coming out are things like this Notebook LM that Google just came out with. I don't know if any of you had a chance to play with that around yet, but you know, so basically it's a place where you can put like up to 50 source documents, and each document can be 500,000 words. So basically you can put 50,000 page books and just drop it into this Notebook LM, and then you can ask it, you know, questions about that. You can summarize each one, or it can provide an overall summary. You could have a mix of documents that might be some of your operating procedures and how you operate your business, along with regulatory documents, and ask it to tell you things that you should be paying attention to. Yeah, and so that's a recent tool that Google just came out. It's actually, there's no cost for that right now. They may add a cost, but that's the other thing really with these AI tools, and it may change, but the paid version is still so inexpensive relative to the potential value that you can get out of these systems. And again, this sort of comes back to the experimentation. You know, you in order to sort of make that work, especially if you're doing it in-house like this, you have to have an organization culture that's supportive of using AI. I like to use the term a positive AI culture. And, you know, that means that there has to be things like kind of permission given by top management that it's okay to experiment and try and use AI to find use cases that might be helpful to you in the work that you're doing. You know, you also have to have the tools and, you know, and the policy as well, and some training too, workshops and things like that. And then as you're doing your work, you know, you're starting to think about, hey, how I can use this for my work, but then also you're thinking about it as you get better and better at sort of the team level, and then even the organization level, how you can add AI in those different levels and that kind of thing. And, you know, that's what I have seen from companies not in the green space or green finance space, but other companies as well that seem to really be leaning into it. One company happens to be the Portland Trailblazers. There's some folks on the top management team there that are very engaged in creating this like AI positive culture at the Blazers, and wanting people to experiment with AI, not even for just their work stuff, but playing with it, you know, like on other personal things like that. Because what you're doing is you're learning kind of these capabilities of what it can and can't do. And again, they have a supportive culture there where people in the organization know that it's okay, and they have the tools, and they have lunch and learns and a bunch of those kinds of things.
Yeah, I mean, education is huge. I think that's something our administrators might touch on during their executive chat, because I know it's something we certainly struggle with here in government, is how best to do that. But it does sound like there is promise here with some of the issues they were talking about in AI. I guess on the flip side, if you did have a bunch of kind of finance companies starting to integrate these tools, what are kind of the biggest dangers you see with that, both now and then maybe in the future? And again, I know there's a lot of potential variable there, is depending on what experts they have and how well they do it, but in kind of general terms, what would you be worried about?
Yeah, well, you know, the data privacy and confidentiality is obviously a clear one. It seems, well, the big tech companies that are providing these products are definitely recognizing this as a big challenge, and they want to make sure that their enterprise customers are comfortable with the data, and with this issue. So, you know, all of the major algorithms from Google and Microsoft and Anthropic and all of them basically do have options where you can, you know, turn off using anything that you upload into, that'll go into the training data, that kind of thing. That Google or the Notebook LM that I was just talking about, all that data is not, none of that data gets included or uploaded at all. It's all kind of your own separate sort of private LLM, which is pretty cool. But that's still a big issue and a concern and a worry. And so that's something. And then, you know, there's just, we can kind of tick off some of these other problems, and maybe again, Josh or Kirsten might want to comment on, but you know, there is still the hallucinations, and that's something that they're working on as well. One simple example of that is, I have, you know, the idea of a Turing test, right? Where AI is sort of, you can't tell the difference between AI and humans and stuff. So one of my Turing tests for these AI algorithms has been doing the Wordle, you know, the Wordle game, right? Where you have to come up with a 5-letter word. And if you try to do Wordle with Gemini or OpenAI 4.0 or whatever, it's not very good. It's better than, it's helpful. Like if I do it with Wordle, sort of what we were talking about, human in the loop, there needs to be a human in the loop, because it will often give you good guesses, but sometimes it'll give you a 4-letter word or a 6-letter word, you know, or whatever. But not very good. None of them could do it. But then OpenAI also recently came out with their O1 model. And this is the one that's a little bit more like a, where basically it takes a little bit more time, but it checks its answer. So it tries to address the hallucination issue and stuff. And I played Wordle with it about 10 times, and 9 out of 10 times it was perfect. Once it made a mistake where it kind of gave a word that included a letter that it already should have known that didn't. But it's pretty amazing. And so, you know, so that's just another example of where this hallucinations problem has been really bad, and can, you know, if you don't know what you're doing, then you can end up using some of the output, even though it's wrong. And if you knew what you were doing, you'd realize that kind of thing. Of course, that's been an issue too on campus and teaching and student assignments and things like that. But the AI is getting better. And again, that's kind of a common theme here. But, you know, there are other questions, obviously, around the carbon footprint, and there's the whole energy issue. And a lot of the algorithms are more efficient, but still talking about kind of as they continue to scale up. So, you know, the next model has, you know, another billion. It's 1,000 or 1,000,000 times bigger. And so even if it is a lot more efficient, it's still taking a lot of energy and that kind of thing, right? You know, there's still issues around the lawsuits. You know, a lot of the data that was used in all the training models was sort of scraped from the web based on all the fair use stuff, before laws maybe have changed. And so there's still questions there, and maybe they'll change in the future. So ethical issues there. And then I guess we could just talk about a few other things, or just sort of throw them on the list too. You know, it's sort of like, as we rely more and more on AI, does that mean that we're relying less on our own human capabilities? And so, you know, sort of like as we use Google Maps and things like that, versus being able to actually get around and use maps and that kind of stuff. So there's some kind of questions there. There's the sort of digital divide about all this. What's it all mean? And in the long run, you know, we're talking about ESG and green finance things here, but are we using tools that ultimately are going to cause bigger problems for society and things like that? And so how does that factor into it? And jobs, it definitely clearly seems like jobs are going to be impacted in many fields, all fields pretty much, it seems like. And, you know, we talk about people doing new things, but or different things, you know, I think about being here at the University of Portland on a campus and what's it going to look like even in 5 years. And it may not be that different here, but there'll definitely be different forms of universities and education, and students are going to have more choices and lots of things like that, right? So, yeah, so those are all things to think about. And, you know, down the road, there's even, where does all this play out? Maybe we could save that for later if we have time.
Yeah, yeah, definitely a lot to think about. I always think the energy use is like a particularly interesting one in this context, because it's like, okay, so we have this tool that could maybe give us better financial returns, give us more accurate data, make these things more accessible, but at the same time, maybe contribute to the very problem that green finance is trying to solve. So it's definitely difficult. But thank you. I will let you go for the time being, and maybe turn back to Kirsten. So John just talked about a lot of the potential issues that AI brings in the system, and I know this is something that every regulator is dealing with. What is kind of top of mind for you when thinking about this technology in this space?
You know, AI is really fascinating. And I say that as the daughter of an IBMer. So I've been hearing about AI for 40 years plus, back to the days of the chess game, so to speak. The thing that I think worries me the most from a regulatory standpoint when it comes to AI is making sure that we get the right balance when it comes to regulations. Because AI is just, everybody's focused on it so much. I mean, I'm kind of have to chuckle because I'm sitting here, you know, participating in this, and my email was popping up and I saw one for a CLE on AI. I mean, it literally everyone's talking about it. And because everybody's talking about it, we're getting a lot of calls about how are you going to regulate it? And the problem is, it's like part of this is not driven by the division. It's of course driven by the legislature. And I have to be honest that I'm a little worried. We can't have a one size fits all solution for AI, because what works for one industry may not in fact work for another. And we regulate over 20 programs here. And so very conscientious of the fact that, you know, banks are very different from check cashers, who are very different from money transmitters, and how this technology gets wrapped into their industries is going to be most likely very different. And so one type of regulation just isn't, or one set of regulations just isn't going to work for everybody. It's also that whole thought of how do we regulate AI so that we can maximize the benefits that can come from it, both as a regulator, because I see it as an opportunity to really maximize the use of our resources. You know, we do have limited resources. And so if we can find ways to have AI help us identify, you know, who are the riskiest companies, so we can focus on those for exams and maybe do lighter touch exams on less risky companies, you know, things like that. I want to make sure that we're maximizing that without bringing in some of the negatives that can come with AI. You know, if the information the AI is using to learn from is biased or tainted, we can get to bad results. And we want to eliminate the bad results and increase the good ones. And where do you draw that line and how do you draw that line, I think are really incredibly important decisions that need to be made, but need to be made very thoughtfully so that we do it right. You know, AI really runs into these areas of issues with, you know, getting to those inaccurate results. We talk about that a lot. You know, we need to be able to understand how it's working, and we need to be testing it to make sure that it's getting to the right answer. So there always is going to be, as you know, John mentioned, that human element that has to be looking in and making sure that the AI is functioning in the way that we want it to, and not leading to, you know, unfair decisions. You know, I focus on mortgage a lot because it's the industry I'm closest to. Been doing mortgage work for 25 years. And we have a lot of bad decisions that came out in mortgage, issues with redlining and things like that. And my concern is, do those bad historical decisions get baked into future decisions, because that's what AI is basing its decision algorithm on. And then there's huge concerns about data privacy and security. This is an area where we're constantly focused on. You have to use a lot of data in AI to get to the correct system and to have an accurate model. But that's a lot of data. And how do you make sure that that data is protected and only used in appropriate ways, and that people's information is kept secure? So that's one other area where AI brings up a lot of regulatory concerns. We're already concerned with data privacy. This just adds another layer to it. Just how rapidly it's changing and trying to stay on top of it. I mean, I remember the dates, how old I am, but the days when the internet was first starting to be used and we were questioning, concerns about it and how do you regulate it? And I feel like it's deja vu, same concerns, just different topic now. So, same thing with AI. It's gonna change rapidly, and how do we stay on top of it and make sure that as we're writing regulations for it, because we know that there will be regulations, we write those regulations to allow it to evolve and become better and not stifle innovation and technology, but still protect people. It's always that concern of not being so prescriptive that you stop potential good beneficial things. And so those are some of the concerns that really are coming at us from a regulatory aspect when you look at AI.
Yeah. And you're right, that is such an incredibly difficult balance to strike. It's like, I don't know if anyone can find a use case in history where they're like, the regulations were perfect. That was just exactly what we needed. But we certainly do our best. Okay, so Josh, I feel like you're like closest to the ground with all of this. Like, you work inside a company. As all this is like coming at you all, what are you guys considering from an operational standpoint about AI? How can it be useful? What are your concerns? All of that.
Sure. So I'll provide an example of how we're currently engaging the question through an operational lens at Modernist, and then maybe discuss some of the regulatory concerns we have specifically for this application, much of which is going to echo what Kirsten and Professor Down have already identified. But we're a small team. There's 6 of us. We have identified that time is our most valuable resource, and the vast majority of our time is spent in service of our clients. And so we are spending a lot of time asking ourselves how to improve systems to become more efficient, more productive in service of our clients, to better serve them, but then to also create capacity to develop other areas of the business. We spend the vast majority of our time in client meeting prep and follow-up activities, just ensuring that the information provided to the client is understandable to the layperson, that is in their best interest, that is empowering to them as they weigh challenging financial decisions within various complicated overlapping systems, right? Markets, tax, values, estate planning, et cetera. And so what we need to ensure, we need the ability to ensure the actions we execute on their behalf are accurate and timely. And so one of the ways that we've been exploring how to solve for this problem, the market has kindly provided AI meeting summary tools, which have become much more common. Some have been designed specifically for financial services companies. But for these models to work, it requires the AI being fed really significant amounts of information, some of it highly sensitive to the client, their businesses, the companies they work for. And to further optimize and maximize the platform benefit, the tool really requires integration with other platforms like a CRM. And so this gives us as practitioners real concern from a data security perspective. And on the one hand, we are observing these tools that are promising productivity enhancement, the opportunity to save time. And on the other hand, there's this new risk that's been introduced for data privacy and security. And frankly, we're not sure the technology companies fully understand the risks or that they are as motivated by the fiduciary standard as we are. So happy to unpack that or speak more specifically about how we are seeing the concerns that we have, but up against the regulatory environment.
Yeah, why don't you speak a little bit more on that? I feel like it's particularly salient given we have, both industry members and regulators here.
Sure. So,
yeah, and Josh, I was kind of curious if you were looking at working with a new kind of startup partner company, or is this a company you already have a relationship with that's adding some new features and AI kind of functionality?
This is a new platform, and I'll caveat this by saying we've been intentionally slow to adopt and roll out any novel technology platforms, any AI, just because we don't fully understand the regulatory landscape. And so we were waiting for other financial services companies to confirm the sorts of platforms that they've been using, the larger institutions that have IT departments that can really put it through the ringer and identify any issues. And so we are just now beginning to explore internally what a platform with this sort of AI functionality can do. We're not going to integrate it with any sort of client-related meetings yet. We're just doing it and testing it on ourselves internally for a number of reasons. And I'll get to some of those risks. Obviously, concerns as Kirsten and as John have said, data privacy and security risks, data accuracy and quality, right? One of the challenges with these AI meeting summary tools is the possibility of bias and inaccuracy, and especially in AI-driven transcription tools, these tools might misinterpret accents or some spoken words or technical terms. So there's an equity question that we have and how well this serves the market broadly. And of course, that can, if the tool is misinterpreting information, that can lead to inaccuracies in meeting notes or summaries, which introduces a whole host of concerns. Another operational risk that we've identified is just the obvious budgetary constraints for a small team. And so in addition to the financial costs of learning a new platform, of onboarding a new platform, it's unclear how much time we need to spend maintaining, training, learning the new technology to get it to perform accurately in our environment. And then, of course, that's going to have real impacts on our compliance program. And so beyond the operational concerns, we also have some broader ethical concerns about the implications of applying AI at scale, given the unknown social costs that might emerge. And I think, Professor Down, you spoke to that a little bit, and I'll speak to them now. Maybe we can touch on these further. But over-reliance on automation, as you mentioned, Professor Down, can lead to the loss of human engagement. And as a human-centered firm, we believe that there's always going to be a need for crucial human reasoning and logic, especially when it comes to ethical decision-making. And then from a macro perspective, we really have two primary concerns: wealth inequality and the health of global markets. And we're concerned that large-scale deployment, as you said, Professor Down, could increase wealth inequality by displacing jobs. I know you didn't specifically reference an increase in wealth inequality, but that's the concern that we have due to job displacement. And this might shift concentrations of wealth into the hands of fewer and fewer highly skilled technocrats, if you will. And some folks have been doing interesting work in this area. Eric Brynjolfsson, he's an economist at Stanford, the director at Stanford's Digital Economy Lab, and a fellow at Stanford Institute for Human-Centered Design, he argues that by actually improving productivity of those with advanced skills, these technocrats, these high-skilled workers, this will actually exacerbate the issue of wealth inequality because it will transfer more wealth to the owners of capital while reducing the need for lower skilled jobs. And so there's a social concern that we have. And then the broader impact on global markets. I really like the example that you used, Professor Down, of the AlphaGo ability of these novel tools to be creative. So finance is already challenging enough to understand. We can look at recent history, and I'll come back around to the AlphaGo example. But 2008 financial crisis was in large part due to complicated investment vehicles like CDOs. And so collateralized debt obligations, they were poorly understood by consumers across the industry, poorly regulated, and it fueled the crisis by facilitating the distribution of really risky mortgage debt. So investors didn't understand the risk. It helped inflate the housing bubble. And of course, when default spiked, the CDO market collapsed with losses across the system. And so I don't think it's unrealistic or unreasonable to ask the question, what happens in a not so distant future where AI creates new investment vehicles because, as the professor has stated, it is creative. And what happens if these new investment vehicles are many times more complex than the example of a CDO, and it poses risks in ways that we can't yet comprehend? What happens in that environment? And what happens if fewer and fewer people understand the financial system, a system that's fundamentally built on trust? What unforeseen challenges are going to emerge? What are the implications if trust in the financial system erodes? Because again, increasingly fewer people understand the AI processes that govern them. So those are some of the bigger concerns that we have. Happy to speak to any of those in detail or the specific use case about the AI meeting summary tool, if you like.
I appreciate that. Believe it or not, we actually are 3 minutes out from the end of our panel and a break, and I want to make sure people have their break. We did get a question in the chat, I think actually before Kirsten answered it in one of her answers, about the limitations of regulating AI on the state level, which I think she actually already addressed beautifully. So I think in our last couple minutes to end, and thank all three of you so much, maybe Professor Dan, you could just give a couple thoughts on where you see this tech going in the near future. I know you've spoken on that a bit, but maybe just your personal opinion about the next 5 to 10 years for AI and what we can expect.
Yeah, I think that, there is definitely a lot of reasons to be concerned about where it's going, because we know there's so much momentum behind it. And, when we think about regulation, I was wondering, even Kirsten, so California had that Senate Bill 1047. That was the one that was going to regulate the AI companies. And one thing that I think is really good about what we're doing today is that bill was passed by the California legislature, and then it went to Governor Newsom's desk. And then there was tremendous pushback from most of the big tech companies and the billionaires that lead them, saying that this is bad and we can't do this. If we do this, then, there's all kinds of reasons not to do it. But I do think that what we're doing here today is really good to get more people thinking about AI and involved in AI. And that's one reason that I think even, having people experiment with some AI, with some of the tools and things like that in a responsible way within organizations, then they're going to be more inclined to try to engage with some of these questions and support regulators like you, Kirsten, in the sort of desire to have AI regulated in a responsible way. And there's so many arguments for, we can't, if we do that, then China will get theirs and all these other things. But somehow we have to, kind of figure this out and do it in a safe and responsible way. So that's kind of a positive externality that I see coming out of all this discussion. And even though I'm concerned about the future with AI, that's why I'm so engaged in trying to get people to experiment with it and learn and engage with it. So that's what I would say.
I think that is an excellent note to end on, and why we do try to do these things, because we know that there are so many thoughts from so many different people having so many different experiences in this space right now. So thank you three again very much for your time. I appreciate this. I know I found it very interesting. And for the rest of everyone in the audience, we'll be back in 15 minutes at 10 a.m. to talk a little bit about blockchain and what it might be able to do in this space. Okay, see you soon.
Thank you all.
Hi, Mike. Welcome to the panel. Do you want to test your audio?
Can you hear me all right? Hello?
Yes, we can hear you.
Hello, Mike. This is Melissa. Would you like to test your audio?
Yeah, sure.
Oh, great. It sounds great. And your video's working great too. Thank you for that test. Hello, Brooke. Welcome. Would you like to test your audio and your camera?
Yeah, hopefully that works for the audio. I'll get my camera going in a second here. You
Yes,
hear me?
audio is great. Thank you.
Okay, good. Then camera, can you see me okay?
Yes, that looks great.
Okay,
All
awesome.
right. Thank you for
I'll
the
mute myself
test.
again then, yeah, for a sec.
Okay, thank
Cool,
you.
thanks.
Hi, Alex. Welcome. Would you like to test your audio?
Sure. Hello, can you hear me?
Oh, great. Your audio sounds great and your video is
Perfect.
good too. Thank you for the
Wonderful.
test.
Yep, thank you.
Welcome.
All right, well, looks like we're past the 10 a.m. mark and we have all our panelists. So Hopefully everybody got a chance to grab some more coffee and is ready to dig into our second panel, which will explore the intersection of blockchain and green finance. Remember that time allowing, we will take questions at the end. So if you're in the audience, please feel free to use that Q&A function and we will try our best to get to them. So we are lucky enough to have three true experts in the intersection between blockchain and green finance with us today. First is Alex Murray. Alex is an assistant professor of management at the University of Oregon, where he serves as director of the Intelligent Futures Lab and faculty advisor to the Oregon Blockchain Group. He teaches courses in entrepreneurship and technology innovation. Specifically, his research examines how emerging technologies such as blockchain and AI impact organizations and society. Alex's research has been published in several scholarly outlets. Previously, he was a senior researcher at ETH Zurich, received his PhD from the University of Washington. He co-founded Forza Financial, worked as an analyst with Grayman Foundation's Impact Investment Team, and worked with an agricultural technology startup in Nairobi, Kenya. Thank you for being here today with us, Alex. We also have Mike Zyko. Hopefully I got that right, Mike. Mike is the co-founder and managing partner at Lattice, an early-stage venture fund focused on digital assets. He's also a pioneer in the decentralized physical infrastructure network sector. Mike has made notable seed investments in projects like Dymo, Blockcast, and Daylight. At the intersection of decentralized networks and green finance, he has led investments in Solar Protocol Glow and the distributed energy resources network Daylight. Before founding Lattice, Mike headed new token listings at CoinList. Early in his career, he served as a director on Facebook's marketing solutions team, managing top-tier clients like Google, GoPro, and Beats by Dr. Dre. And then finally, we have Brooke Pollock. Brooke is the founder and managing partner of Hut Capital, a blockchain venture capital fund of funds platform. Prior to Hut Capital, Brooke spent decades investing across private fund, secondary, and direct strategies with a leading global investment firm. Most recently, he spent more than 4 years with Greenspan Associates, a venture capital platform with more than $17 billion under management. Early in his career, Brooke was at Hamilton Lane, a global private equity advisory and asset management firm where he focused on private equity, secondary transactions. Prior, he was at CTC Consulting, an investment consulting firm for ultra-high net worth individuals and families, where he focused on sourcing, diligence, and monitoring fund investments across a wide range of private strategies. Brooke received his undergraduate degree from Oregon State University and is a certified financial analyst. I just gave the audience a rundown of your very impressive resumes. But considering they were kind of in block information forms, I would still very much appreciate if each of you could just, in more layman's terms, describe what it is you do, and maybe what brought you into the blockchain space, because that now dominates all three of your careers. We can start with Alex. And Alex, since you are also the educator, maybe you could give everyone a definition of blockchain, just so we're all on the same page. Remember, public event.
Awesome. Thank you, Nicole. And thank you all for being here. So as Nicole said, my name is Alex Murray. I'm an assistant professor at the University of Oregon. So I'm in the Lundquist College of Business down in Eugene. So I teach classes on entrepreneurship, technology, innovation, and I've been there now for about 6 years. So as she also said, I am faculty advisor to the Oregon Blockchain Group, so work with a lot of students on their blockchain projects, also take them to conferences, trips across the country. And we have a research lab now that looks really at the impact of emerging technologies, so blockchain and AI, on the future of work, organizations, and society. And I guess the other question there was, how did I get into blockchains? It was actually when I was at the University of Washington. It was kind of just something that I'd been exposed to probably 2015, 2016, and I had wanted to write my dissertation on the topic at the time. Advisors told me not to engage in futurism, so I didn't at the time, but it was always kind of in the back of my mind. And as I was doing work on crowdfunding, entrepreneurial finance, on organizational design, there was always kind of this voice in the back saying, well, how would that look on a blockchain? Which then gets to the next question. I think you asked me to define blockchain for the group. So I'll try to do this, really high level. I'm not going into too much depth here, but it's most basic. Blockchain is just a decentralized ledger system. So, you can think about it, instead of a ledger that's recorded, say, by one or two centralized entities, blockchain just allows transactions to be recorded across several computers in a decentralized network in a way that's transparent, secure, and immutable. So you could think about this as, the underlying technology for cryptocurrencies, but also as the underlying technology for a number of different applications, such as supply chains or decentralized energy grids. origins of, say, different materials or objects as it goes between exchange partners. So I'll stop there. Thank you so much.
No, I appreciate that. And I feel like I hear that a lot from people in the blockchain space, that there's something that was just calling to them about the new tech. Mike, how about you?
Yeah, thanks, Nicole, and thanks everyone for joining in. Like Nicole said, my name is Mike Zyko. You did get the pronunciation right, so good job there. It can be a challenge. I'm the co-founder of Lattice. We're an early stage venture fund focused on crypto and digital assets specifically. We founded the fund in 2021, raised $20 million. Then subsequently in 2022, raised $65 million to invest in early stage, meaning pre-seed or seed stage startups that generally have an idea for a new crypto application or protocol that they want to launch. So we'll invest in them in various capacities, either they're as their largest investor or maybe as a follow-on investor, and help them along in the journey to growing and eventually being a successful app or protocol. Prior to Lattice, I was at another crypto company, and then I guess my journey getting into crypto, everyone kind of has like a circuitous path into this space. In my specific example, I was living in San Francisco and met a friend of mine who just said, "Hey, I'm really into this thing called Ethereum." I'd never heard of it. I'd heard of Bitcoin. This is back in 2015 or so. And he shared with me, "Hey, like you should definitely look into this and learn about it." I kind of forgot about it for a few months, but then stumbled upon an article a few months later in the Wall Street Journal talking about Ethereum again. I said, "Okay, maybe I'll take a look at this point of time." And I was at Facebook, and Facebook has this very centralized, clearly approach to product development and what they do. Obviously, they've been quite successful, but that centralized force can sometimes kind of stamp out entrepreneurship in various capacities because there's just not room for new entrants, because they can just dominate given the leverage they have from all the users, the billions of users they have. And I was looking for just kind of the next paradigm shift for app development or for developers to build in a new way. And this just seemed like a very exciting, totally green space that wasn't entrenched in the existing technology stack that was already being used in Silicon Valley. So left Facebook to join this company called CoinList, which was helping new crypto projects launch their tokens, projects like people have probably heard of, like Solana or Filecoin, Blockstack, Celo, and a bunch of others. And eventually left to start this fund, Lattice, which I'm currently with today. Thanks.
Nice. Yeah, it seems like you definitely have a breadth of experience in the industry. I think we will move on to Brooke. Brooke, welcome.
Yeah, thanks, Nicole, and hey, Mike, hey, Alex. So yes, I'm Brooke. I live in the Portland area. Not born, but here, but from here. Moved here as a kid. So this is home. I graduated from Oregon State University. I spent my career in the private markets world. So I these days run a firm called Hut Capital. We're a blockchain venture fund-to-funds platform. So what that means is that we invest in early stage blockchain venture capital funds. So these are funds that are, funding very early stage projects across the blockchain space. And we back, a number of different funds focused on different parts of the market and different geographies, kind of build a broad portfolio across the space. We also invest in some startup ourselves in this category as well. Been doing this for about 6 years, based here. My background prior to this was a decade doing pretty similar things, just not dedicated to the blockchain and crypto space. So I worked in the traditional venture world for 4 years before this, working for a very large firm that you mentioned earlier. Spent some time in the private equity secondaries world, kind of trading private fund interests, and started my career here with a local firm called CTC Consulting, where we helped wealthy families to invest their money, among other things. In terms of how I got interested in this space, I started my first job out of college 3 weeks before Lehman crashed, for those who are familiar. So my welcome to professional life was seeing our existing financial system kind of crumble around us, and its flaws were quite clear. And, so I didn't instantly get into blockchain because Bitcoin technically didn't exist when that happened, of course, but I think it led me down the path that I'm on now where, I was working in venture capital and heard about, really dug into Bitcoin for the first time in late 2014. But in 2017, just really spent way more time learning about the space. And the idea of building this kind of new, much better, more transparent and open financial system on blockchain rails really attracted me. And that's kind of what really brought me into this space and have been working on this ever since.
Yeah, and I think that is a great segue into starting to talk more about green finance, open, transparent, accountable, certainly some of the issues that we're facing in that sector. So on that, I think I'm going to stay with you, Brooke. So you're a CFA, you've spent most of your career in the investment space. On the last panel, they touched briefly on kind of the ESG backlash we're seeing right now. In your view, is that backlash real? Is it warranted? How do you kind of see that overall?
Yeah, my answer may or may not be brief, but I think it's an important topic. I mean, something I deeply care about. Like I spend a lot of time in the outdoors. Like, this is something I care a lot about related to this space. So we won't get in the weeds of exactly how all this works, but anything that utilizes a proof of work mechanism such as Bitcoin, effectively uses electricity through Bitcoin mining to secure the network. So again, we don't need to get in the weeds of why exactly how that works for today's purpose, but Bitcoin uses about 0.2% of the global energy supply, according to data from BP. So, I mean, overall, it's a very small amount of the global energy supply. And yeah, I think it comes down to inputs and outputs, right? So here, the input is 0.2% of global energy. The output is an incredible form of money that is open, permissionless, global, digital, and not subject to being depreciated by any whims of any government. So I think to some degree it's also an easy target because you can tell exactly how much energy Bitcoin is using. You can track it on a daily basis. A lot of other sources of energy and let's say destruction of our environment are not quite so open and transparent. So I'll give one other example. So let's compare that to Coca-Cola. So in Bitcoin's case, you use 0.2% of the world's energy. Your output, we discussed, I believe it provides enormous benefit. Coca-Cola, I mean, their products literally just give us heart disease and diabetes. They use enormous resources to do so. Think of all the packaging, like plastic bottles, for example, manufacturing plants, all the trucks and logistics that they take to get all those goods around the world. The resources required to make the ingredients, everything that goes in that, et cetera. So I think there's lots of other things out there that are significantly worse than Bitcoin from a cost benefit perspective. I just think Bitcoin is an easy target because it's a new thing. A lot of people have other issues with the industry that are not related to extra electricity, and that it's kind of an easy scapegoat, despite, again, in my view, being a very strong cost benefit from that perspective. I'd also highlight that Bitcoin largely uses sustainable energy. So Bitcoin uses 60% sustainable energy, according to data from the Bitcoin Mining Council. So that is significantly above the general mix of renewable and sustainable energy that we use in the US or the EU, not to mention other countries like like the BRICS, for example, where it's much lower than both the US and EU. So and Bitcoin can be mined anywhere. So it's easy to connect into places where where energy is being wasted, where it can be done through renewable energy sources. So it's much easier to do that than plug in your manufacturing plant, for example, to renewable sources, because that's going to be where it is. You can whereas you can mine Bitcoin from anywhere. So to get some examples, like I'll use some that are further away and some that are closer. But so in the Congo, they built a town called Virunga. They built a Bitcoin mining plant from their local hydroelectric plants. So they mine Bitcoin using local hydroelectric energy. This energy would otherwise be wasted. They generate $150,000 per month doing so, and that money goes to pay salaries and costs of the local wildlife reserve, which is under constant attack from poachers. So in that case, Bitcoin is providing huge benefits to to that community. They also use it to help fuel the local chocolate industry, which again allows some of the chocolate to be made there, where typically they export the beans because it's very difficult to do so locally with the expense. So again, Bitcoin is providing huge benefits to that industry or that community over in the Congo. More locally, so Crusoe here in the US, they mine Bitcoin with natural gas flares. So they take energy that is literally just being burnt out in the atmosphere. Excess natural gas that gets burnt out of those pipes. They use that and they mine Bitcoin with it. So again, mining Bitcoin with energy that is literally just wasted and burnt into the atmosphere otherwise. There's also a local company here in Portland called Pantalasa. They harness wave energy. So they make these, I guess you call them like pods. You put them out in the ocean, they harness wave energy. And, it's clearly, a renewable source of energy. Them and many other companies that are providing new sources of renewable energy will actually mine Bitcoin before they're connected to the grid, because they can start generating revenue, help to bootstrap and ensure those projects come to fruition and provide renewable energy into the system, and use the Bitcoin mining to generate revenue in the early days before they can connect to the grid, and again, make sure that source of energy comes to fruition. So again, I think there's a lot of other benefits of Bitcoin in actually spurring renewable energy development that are significantly underappreciated. So anyways, I'll stop talking, but I do think this backlash is overblown. Again, if you look at it from what's the input and what's the output of this, and I think the backlash has subsided to some degree. I think will continue to subside as folks kind of more realize the reality of this over time, and that eventually folks will come to appreciate those benefits.
Thank you. Yeah, I think that is an interesting framework with which to view this discussion, and one that we touched on last panel, because AI likewise can take huge amounts of energy. And so when you're thinking about use cases to try to make a more sustainable environment, I think that's kind of like the first instinct a lot of people have, especially with blockchain, is, but it takes up all this energy.
And if I can say one last thing real quick, most blockchains don't use mining, and so they're actually using very little energy. So Ethereum, for example, which there's more built on than any other blockchain, it uses a different mechanism that doesn't use mining, so it uses I think 99% less energy than Bitcoin. So most blockchains actually don't have a significant energy drain. It's really just Bitcoin that is kind of subject to those conversations.
Yeah. I mean, yes. I mean, I think that it's certainly been a kind of a touch point for a lot of those conversations, but I feel like we see it in some other technology conversations as well, like the one we just had. Maybe more broadly, when we're talking about ESG, it's interesting because it's not just Bitcoin. Like we see this kind of, at least I've seen a lot in the news, but a broader ESG backlash around kind of whether or not it's actually doing what it says it's doing, like whether or not these green investments are quote unquote green. And some of that has to do on our end as regulators, providing proper definitions and things like that. But I also think it could be something that blockchain could help with. So I think I'm gonna pivot to Alex, because I know that you have done some specific projects on supply chain transparency and the very definition you gave of blockchain. I mean, when people think of blockchain, what do they think of? Something that is transparent and immutable. So do you see this as something that could help in this space?
Yeah, so I guess the short answer there is absolutely, but let's qualify that. So like you said, I've done some research on decentralized energy grids and also supply chains. And then here, one of the primary use cases of blockchain is documenting provenance or the origin of assets and material. So anything that goes into a supply chain, any material that goes into, say, a product that's finally delivered to consumers, that can be recorded on chains. You can document, provenance, origin, and understand, for instance, does it meet ESG criteria? If so, move forward in supply chain. If not, maybe that's a violation of a contract. If there's a smart contract in place, then you can say, oh, that's a violating set of criteria. We need to revisit this and analyze this and, make sure that if ESG is something that we want to ensure is baked into or considered in the final products that we're bringing to market, that is brought in. Also, when I was on faculty at ETH, so in Switzerland, we did a lot of research with Modem, and then we found that technology was effective in tracking pharmaceuticals in supply chains. So that was essentially ensuring that they maintain desired temperatures. But I bring that up because it shows that you can put sensors into this, have sensor data and, being fed to the blockchain in real time. And if, say, the temperature exceeds the desired threshold, once again, that could then trip, a conversation to happen of, oh, this is not a desired set of criteria for whatever good is going through from point A to point B to point C. And I brought up the decentralized energy grids. I can talk about that real quick as well. We've done some work with WePower and Power Ledger. And essentially, blockchain's being used there to track and record the origin of energy. So you can see, oh, yes, it's from a clean source or a dirty source, whether it be from coal or from, wind or, hydro. So I think just at a higher level, when you take a step back and just look at, the use cases of blockchain within supply chain, within decentralized energy grids, within these, essentially these inter-firm or inter-individual social processes with a, financial output, that being, the trade of good or the sale of goods, you can see all those inputs going in along the way. And that's what we found. And I expect that to continue to be generalized across different contexts and to be utilized.
Yeah, that makes a lot of sense to me. And I think that that's kind of like one of the first use cases that comes to mind when we're talking about this space. I think the other thing that immutability and transparency allows for kind of inherently is decentralization, which you just touched on. But I think I'm going to bring in Mike because I know that he is kind of a pioneer in the decentralized physical infrastructure network space, which is something that I know has been a hot topic in blockchain news and something I've been kind of interested in. So do you think you could describe, Mike, just what are DPINs and why are they becoming a hot topic right now? If you know, maybe you don't.
Sure. Yeah, I'll dive in on that front. So yeah, a DPIN or a decentralized physical infrastructure network. I use the definition of a permissionless protocol, meaning anyone can access it, and it's a set of rules or a set of code, effectively, that uses crypto economic incentives. So we'll just say some economic incentive to incentivize the deployment of some real world physical infrastructure. So most people think of crypto or the blockchain space as this purely digital thing, but ultimately there's in many cases, some physical infrastructure behind it. So Brooke just talked about Bitcoin extensively, and that's a very clear example. And while most people don't think of Bitcoin as a DPIN network, if you use the definition that I just provided, a permissionless protocol, which the Bitcoin blockchain is, that uses crypto economic incentives, which Bitcoin is, to drive the deployment of real world physical infrastructure. And in this case, this is data centers that do the mining for the Bitcoin network. So that's kind of like the most basic definition. But more recently, that strategy of getting people to coordinate around the world around some objective has been utilized in a variety of capacities, whether that's wireless networks for 5G, Wi-Fi, fixed wireless. It could be energy grids, sensor networks, really anywhere where you need some hardware put out into the world in order to take advantage of either latent supply, meaning like, hey, people have spare capacity on their computer and they want to provide compute for it, or you want people to put up actual real world infrastructure from scratch. So in that case, these wireless networks, like something called Helium, are a good example of that, where people actually go out, they buy specifically produced hardware in order to provide wireless to the network. So I think the reason it's become more popular is, one, it's a very effective way to deploy infrastructure into the world. And then also, I think naturally people are always looking for more tangible use cases behind these new technologies. So while certain things like NFTs, which maybe people have heard of, these sort of digital collectibles, are kind of exciting and interesting, it's a little bit harder for people to relate to them or understand why it's important. Whereas understanding why a wireless network that's providing cell phone coverage for people is interesting, is much more tangible, much easier to understand. And because these are actually hitting some level of scale now, where it's not just an experiment, but it's actually being used in production in the real world, I think people can point to that and say, oh, this is a very viable use case for blockchains and these crypto networks that hadn't been considered before as a use case, that are maybe different than ones in the past. So while Bitcoin's been around for a very long time, and I think we can call it a DPIN, the newer sort of like next generation versions of this are deployed in different areas. But I think just Bitcoin's a very easy example because it's so simple, because you put up these mining facilities and use Bitcoin to incentivize those mining facilities to be put up around the world.
Yeah, I think that's a great point. I feel like so often in this space, people view crypto assets as like purely speculative things. And we're starting to kind of see broader use cases that are bringing it into the real world. I think one interesting thing about Lattice is that you have invested directly into funds that are into projects that are already doing this sort of thing. So I know in your bio, I mentioned Daylight and Glow, which are both specifically focused around creating a sustainable energy economy. So aside from what these things are more generally, maybe you could talk specifically about how these companies are literally doing it today.
Sure. Yeah. Daylight and Glow are two really good examples of companies we've invested in. So I'll mention, I'll talk about Daylight first. So in their case, what they're trying to do is use crypto economic incentives, which they haven't launched a token yet. It's still a little early for that. So they're maybe in that beta or product development phase. But what their goal is to aggregate distributed energy resources. So in this case, that could be solar panels, home batteries, thermostats, heat pumps. And if you look at those as energy assets that are separate from the grid and controlled by individuals as opposed to corporations like a power plant, you can use software to start to aggregate them and coordinate them. And depending on what type of grid load or grid capacity a particular region is under, you can start to kind of throttle up or down those resources in order to balance the grid. So in their case, they're tapping into this latent supply of energy resources, which are just sitting out there in individual homes and not really contributing to the broader capacity of a region. And that's very difficult to do without some incentive. So some people have tried just using cash incentives, which, to a certain extent, if someone gets a discount or maybe they get paid a certain amount to do it, it can be interesting. But what we found is these crypto networks where you can have collective ownership over the network. You're not just getting paid cash, you're actually becoming an owner in the same way that you'd become an owner of a startup. If you start to work for it, you maybe get some equity. In this case, you're getting kind of like a programmatic version of equity in the form of a token because you're contributing your supply. So maybe it's a home battery that kind of pushes energy back into the grid or takes energy off when it needs to be. So that's Daylight, and they'll be launching maybe a token sometime in the next 6 months. So if you have, one of those things I just mentioned, a home battery or a thermostat that's compatible with it, you can download the app and get started today and earning sort of these points, which will eventually lead to a token somewhere down the line. In the case of Glow is a really interesting example because the founder has been in crypto for 10 plus years. He launched a token called Saya that did file storage. So the idea here was like, hey, we have all these files online. What if we created a network that could coordinate spare capacity and then people could store their whatever digital files they wanted on it. And he did that. And one of the powers of that network, which you saw, was like you can really get people to do almost anything for crypto tokens. They had people putting up these storage facilities all around the world just to store files, and maybe there wasn't even that much demand for that storage capacity. But after he left that project, he decided, well, I want to do something kind of more useful for the world than just file storage. So he looked around for various use cases, and he stumbled upon solar. And so you can think of solar almost like a green Bitcoin. The idea here being Bitcoin incentivizes people to put up these mining facilities that use energy around the world in order to earn Bitcoin. In the case of Glow, they incentivize people with a token, the Glow token, to put up solar farms around the world. And they monetize those solar farms with carbon credits. So the idea being they can demonstrate that there's additionality, which for people that are kind of more familiar is the demonstration that that green energy or whatever those credits that are produced wouldn't have happened without whatever they are trying to do. Like it's not just something like someone would put a solar farm up anyway. So in their case, they're incentivizing both individuals at their homes or even solar farms if they're putting up large solar farms in India right now. And whatever those solar farms produce from a carbon credit perspective, they can actually sell those, that money goes back into the protocol. So really interesting example of someone that's kind of taking the opposite approach to Bitcoin. Instead of using energy, this is creating energy, and then also creating carbon credits.
Yeah, no, I mean, it's really fascinating. I feel like even taking a broader view of our energy trajectory, at first technology was such a centralizing force, and now we're starting to see it, decentralize again. So I don't know, it's an interesting journey for sure, but it's exciting to see actual use cases coming into fruition with this sort of thing. So
yeah, in their case, they have probably about 50 solar farms already around the world, producing carbon credits and producing energy just from this new economic incentive of the Glow token.
nice. So I feel like the other thing that decentralization comes into play with here, like aside from the real world, is in the investment world. So thank you, Mike. I think I'm going to bring back Alex because I know that you have written a number of papers specifically on crowdfunding. So aside from decentralized physically, decentralized finance, what is that? Can you explain a little bit about that for the audience?
Yeah, and thank you for asking the question. It makes me smile a bit. So as I mentioned earlier, when I was a grad student at the University of Washington, I wrote my dissertation on crowdfunding, but essentially had to write a second dissertation on the intersection of AI and blockchain and the design of decentralized organizations. So that's kind of my nights and weekends project. So it was kind of fun to be asked this question now about the convergence of the two topics as it's kind of come full circle. So I think the question is, what is crowdfunding, then how does it impact kind of our broader conversation about decentralization? So crowdfunding, just at a higher level, it's just the solicitation of resources. So you, me, anyone, log online, usually financial resources, for a project from an audience of resource providers. And it often occurs via the internet. Now, I said it's usually financial resources. However, there's oftentimes product feedback that's generated in discussion forums, maybe evangelism for your product on social platforms. So there are benefits to an entrepreneur or project founder that are generated via the crowdfunding space. However, at its highest level, it's normally crowdfunding solicitation of financial resources from a distributed group of resource providers. So it really helps to disintermediate access to funding, right? So you're removing those gatekeepers like the VCs and the angels in this conversation, and then allowing large swaths of individuals to contribute capital. There's a number of different forms of crowdfunding that actually are interesting when you start thinking about green finance. So oftentimes when people hear crowdfunding, they think Kickstarter, so the rewards-based crowdfunding, right? So they're providing capital in exchange for a future good or service. So you can think about it a bit as a pre-sale. But there's also donation-based crowdfunding. So those are kind of the GoFundMe campaigns. Oftentimes those will be, oh, someone was in an accident, or, oh, we're trying to build a community garden. Can you help finance maybe the medical bills, or help finance, this community initiative? And those are just contributions, donations to a cause. And then you have peer-to-peer lending. So like platforms like Prosper, where you do have, lending platforms. And then also you have equity-based crowdfunding. So that is where, say, you can post a project, maybe it's at a seed funding round, you're trying to raise $1 million, but you don't necessarily have 1 or 2 angel investors lined up as a syndicate. You can maybe seek capital from, say, 10 or 20 individuals who are willing to provide 10,000, 20,000, 100,000. So kind of the 4 main types there: rewards-based, donation-based, equity-based, and peer-to-peer lending. So how can blockchain impact crowdfunding? What does crowdfunding mean for blockchain? I think there's a couple ways to think about this. So one is, studies of crowdfunding oftentimes find it's a social process. So people get really excited when the capital is flowing in and they make these stretch objectives, they make additional promises. And that's where I think the implementation of smart contracts comes into play. So it can allow funds to be released when entrepreneurs meet key milestones, right? So once they hit proof points, once they hit, key objectives along the way, then the next tranche of funds can be released automatically. So maybe it's held, but it's not released until those goals are met. So it prevents that scope creep when you have, these thousands of distributed resource providers who are making requests or seeking different, maybe use cases or different features for a product or service. It also allows for the tokenization of ownership. So essentially, if and I'll get to DAO, actually, I'll bring in DAOs in a second, but if, say, you have tokenized ownership in an equity setting, you can then have a community who has ownership in small stakes over that venture and actually increases the liquidity market a bit. And then finally, so I brought up DAOs. So those are the decentralized autonomous organizations. Essentially, that's where a venture or an entrepreneur could put forth a proposal to a DAO. They have, an aggregation of capital. They have minted a token, and you essentially have this microeconomy where they have a shared interest or a shared belief system, and they put their tokens from, that they've minted into the projects that they believe in or want to see financed. So then you actually kind of shift this mindset of, oh, I don't need to appease a number of different contributors. This entity has voted, they've kind of aggregated their beliefs on what we want, and you can kind of satisfy those objectives as opposed to different entities and having different interests to subscribe to. So I'll stop there, but I think that's kind of at a higher level that, intersection between blockchain and crowdfunding.
It does, and there's definitely a lot there. I guess if you were to kind of summarize for the audience as best you can, why then is blockchain's ability to facilitate crowdfunding potentially important for the growth of green finance?
Okay, I can keep this one brief, I think. So it allows several individuals who may not be resource rich to allocate small amounts of capital to projects they find meaningful. But then it also allows this idea of what is meaningful to shift, right? The investment thesis may not have a centralized or a central market logic. It could have a social logic, a sustainability logic, a communal logic. So whatever is valued by this group, this community, this collective, it allows them to put capital, to put financial backing into things they believe in. And they can essentially judge or adjudicate value in a way they deem fit. So it could be a sustainable green logic as opposed to we need a financial return on this venture or this project.
That makes a lot of sense, and I feel like is going to become more and more important with this new generation of investors who we see tends to value those things more than just financial returns like previous generations. Thank you very much for that. Brooke, I know you've been sitting back there for a bit. When you're thinking about blockchain and green finance, is there anything else that comes to your mind in terms of potential use cases that haven't been covered too much by Alex and Mike? Oh, I think you're still muted.
Oh, yeah, that's not very helpful. I guess I'll double down on DeFi a little and then mention one other, but DeFi, for folks who are not familiar, is decentralized finance. Just think of it as financial services that exist on blockchains. So you can access a protocol that lets you trade one asset for another, or allows you to take out a loan, for example. And it's exceedingly quick and efficient. You can set up in a wallet and start plugging into this array of financial services providers within a few minutes. So it's significantly more accessible and open than traditional financing sources for those who are looking for easier ways to access financing. You can, for example, take out a loan collateralized by whatever asset that you might hold on chain, and again, like do the exceedingly quickly and efficiently relative to our traditional kind of banking and lending system. You can use those funds for anything. Obviously, this category included. Likewise, this is a system that is global and can be accessed from anywhere and who has a smartphone. So there's a lot of places in the world, especially outside the US, where folks want to build these types of things and just don't have access to financial services. So the DeFi space allows a lot of folks who are underbanked, unbanked, and particularly outside the US, where the financial infrastructure is much lesser, to access financial services for various entrepreneurial endeavors, green finance related ones included, in a way which historically has not been possible. So I think that's a very powerful aspect of blockchain. One other is just stable coins, which allows you to access the US dollar wherever you are in the world. So it's not green finance specific, to be clear, but it is a very powerful tool where a lot of folks, especially outside the US, live in countries where their fiat currency is very quickly depreciating, and allows them access to an asset which is not depreciating and much more stable, so that they can plan and have access to to their capital in a sustainable manner, and allows them to build whatever they might want to, this category included. It also allows them to move capital across borders in a far more efficient way, where they can, I can send you a US dollar stablecoin no matter where you are in the world, as long as you have an internet connection. I can send that to you very quickly and cheaply, far more efficiently than like Western Union and other kind of existing methods for cross-border payments. So especially for those in rural areas outside the US, that's an extremely powerful tool for them to use financially. So again, it's not necessarily green finance specific, but I think, a very important one to mention.
Yeah, no kidding. Well, the three of you have certainly given me a lot to think about. And it does seem like there are a lot of, kind of promising use cases for blockchain in this space. But now that we've talked about the good, let's talk a little bit about the bad. So, Mike, I know at the beginning, Brooke talked a lot about Bitcoin specifically and the environmental concerns. You talked about Daylight and Glow, which are creating, more sustainable energy economies. How do you think about that trade-off between the potential of these technologies to use energy versus the potential for them to generate it?
Yeah, I think one of the important things that Brooke mentioned in the conversation is that outside of Bitcoin, there aren't new crypto networks that are being launched that follow the same design paradigm as Bitcoin, where you really need to use a lot of energy. So I think we really moved on from that era, and to a certain extent, Bitcoin is this relic of this first generation design for deploying blockchain networks. So my expectation is either a new crypto network like Ethereum, Solana, et cetera, will just energy is not really a factor in its design. You could have things like Daylight or Glow that are actually coordinating people around the world to solve a problem related to energy. But Bitcoin likely will never move away from its proof of work mining design, which requires electricity. So then you have to take kind of the arguments that Brooke put forward, which is that the output of Bitcoin on a relative basis to some of the other companies or things that exist in the world, like traditional mining, with what you're getting, a reserve asset for the world that could potentially move away from even the dollar, for instance, is a net good for the world that's justified the energy that's put into it. But I think the other piece to this is that because of Bitcoin, we have pushed towards things like more sustainable energy sources, because Bitcoin miners always want to find the cheapest sources of electricity. So they've had a number of strong proponents that have advocated for connecting renewable energy sources to the grid, having more sustainable design for data centers, or chip design that uses less electricity per output, which actually is the backbone for the chip design of AI. So while there are these maybe negative headlines that I think can be associated with Bitcoin, it has proven to both push towards more sustainable energy sources or design, and then the belief being that Bitcoin is a net good for the world, being an advocate for that. So my expectation is the trade-off is not really something that you have to consider as much anymore, just because new networks that are launching just aren't using proof of work anymore.
That's really fascinating to hear because, as someone in the regulatory space, if we do see legislative proposals around blockchain or Bitcoin, I would say 80% of them have something to do with the concern around energy consumption or something like that still. So we might be seeing a little bit of an area there where our regulatory bodies have not quite caught up to where industry is, which is exactly what we're supposed to be doing here.
Definitely. And I think the education, I think, is catching up. Just even since I've been in the industry, I think you see a lot, way less headlines related to energy consumption on Bitcoin, because a lot of those myths have been dispelled, due to people that are, working within the industry and educating folks on how Bitcoin actually works versus, just what one headline says.
Well, I appreciate it. Turns out that may not have been as big of a negative as we thought it was. So I think we'll go back to Brooke and Alex. More generally, do you guys see any other kind of major barriers to adoption and you can think about it in terms of any of the use cases we were talking about. If you're just thinking about what is preventing growth in this space, what comes top of mind? Let's start with Brooke and then move to Alex.
Yeah, I think it's very similar to a lot of new technologies where, think about the internet. I remember being like, maybe back in high school, and I was downloading songs off, some website, and, I was like going extremely slow, and it would take like 15 minutes to download one song. And now I'm streaming everything that ever existed at my fingertips through Spotify. So the user experience of new technologies in the early days is typically pretty poor. There's new behaviors that need to be learned. The building of the technology itself, needs to occur, and that's a long process, similar to what we've seen with higher internet speeds, for example, which allows, one use cases and just existing use cases to be significantly more efficient and accessible. So I think just frankly, the user experience and the development of the technology, which will naturally occur over time, is, a significant barrier today that will ease over time. And people, getting used to new things, for example, like a crypto wallet. So, instead of, logging into a website, you download your, let's say a MetaMask wallet or a Phantom wallet through a browser extension, and you use that to plug into all these financial services, for example, on, that exist on a blockchain. So, the experience is a little different. It just takes time for people to get used to it. At the end of the day, if something is a significantly better product that provides significantly more value versus existing offerings, like that will happen because that will win out over time. But again, there's no big fix per day. There's tons of startups out there that are working on all of this and making much better experiences, much better tooling, like all of this a lot easier. So that'll happen over time. But I think just the current user experience for a lot of this makes it less accessible for some folks.
Interesting. And Alex, what do you think?
I don't have a ton to add to that. I think Brooke was spot on. What I will say, though, is, just in building on this idea that, technologies take time to advance, take time to meet, a user interface that is sensible, logical, that's quick, that, is equal to the current systems and processes they have in place. One thing to look at is the large incumbent firms. What we think about is the hierarchical centralized firms. When is it going to make sense for them to adopt the technology for some of their internal processes, their internal routines? Because right now, a lot of the, existing processes, existing systems they have in place, it doesn't make sense to supplant them from a resource standpoint, for a number of reasons. The technology isn't there to replace those systems. So I think one question will be, when will large incumbent firms start to say, oh, it makes sense for us to adopt this technology? And then I think we'll see broader diffusion.
Yeah, and actually, if I can add one more thing to my comments, I think federal regulatory guidance would be extremely helpful. Really, since this category has existed, there's not been clear guidance from regulators and clear legislation around how founders and startups in this space can operate in a way that is legal and by the rules. Instead, our federal regulators have utilized a regulation by enforcement approach, where they just decide to go out and sue people, and then they kind of try to make a case that they're doing something illegal, even though there maybe is not legislation to dictate that. And it's been a pretty unsuccessful approach if you actually look at the courts and how they've adjudicated those cases. But it's just made a very hostile environment for operating in this space. And if we can have clear federal legislation around, like a stablecoin act, where, here's how you can put out a stablecoin and do it in a way that is legal. Here's how you can launch a token in a way that's legal. And here's when it's a commodity or security. And a lot of this market, like a market structure bill, for example, I think that'd be hugely beneficial for this space. And, would also just make a lot more people feel comfortable starting companies in the space and moving into the space as a profession.
Yeah, I would echo that. I feel like you all but said Gary Gensler's name there, but I understand. And I would say on the state level, I think, we would also appreciate federal legislation in the area. I mean, state by state approaches are always hard, particularly when you have technologies that are everywhere all at once. And so while, yes, we do fall back on, regulation by enforcement, it's not necessarily our preferred approach either, but sometimes, tools at hand and that sort of thing. Okay, we do have a couple audience questions and about 10 minutes left. Before I start digging into some of those, Alex, I know that you have written about the intersection of AI and blockchain. I did want to let you talk about that a little bit, just because I feel like it brings together the whole conversation we've had today thus far. So what does that look like? What are you seeing?
Okay, I can keep this brief, hopefully. Because I do think this is one of the most exciting questions, someone can ask right now. And like you said, we've written a few papers on this intersection, and we're actually in the early stages of a book project that's related to this topic. So in short, I wasn't on the panel earlier, I didn't attend it, but I can imagine some of the documented pitfalls of AI came up, right? The propagation of misinformation, deepfakes, hallucination, the list goes on. And with regulatory guardrails lacking, there is an opportunity, I think, for blockchain-based systems to provide a means to validate input data in AI models and ensure the generative processes of AI models and also ensure the validity of outputs. So essentially, there's also this opportunity, and this is a conversation that we've been having and exploring through a theoretical lens, to have tokenized ownership over data that would enable the creation of a non-hierarchical public use AI. There's a lot of conversation around, the centralization of our data in these AI models. But what would it mean to have users own their data, essentially provide permissioned ownership of that data for use in models, and what could that system look like in a Web3 version of the internet? So we've been talking a bit about that and exploring that. So I'll just leave it at that, but I do think there's a lot of opportunities both in the design of organizations, but particularly in the design of generative AI models that are public good or public assets, or in the commons, if you will.
Yeah, that's interesting. I feel like I haven't seen much on that intersection, but it really only makes sense at this point that that's what's coming down the line. Okay, so now we're going to move into, we got 2 audience questions. One of them is a little bit long, but I'm going to try my best to summarize it for you all. And anyone who has thoughts, feel free to jump in and answer. So one of our audience members asked, the strength of blockchain lies with the capacity to teach data attached to an entity. Do any of the panelists worry that the complexity of blockchain will lead to similar disconnects between investors and the core investment, like the derivatives market that led up to the Great Recession? And then he provides some more context beyond that. I know it's a question.
Yes, I saw the question. I think yes and no. So if you're dealing fully in an on-chain capacity, so if you're working within the DeFi ecosystem, for example, where all of these transactions are on-chain and digitally native, so you're only referencing digital assets which exist on chain. You can see exactly what's happening. It's very transparent, and you know exactly if the collateral is there or if the asset base that they say is there because you can see it on chain. So in that sense, it really does de-risk our financial system if we have it on chain, because you can see exactly what different parties hold. And again, if you have the same assets that is used as collateral in 3 different systems, you can see things like that. Where the answer would be yes is that if you're bringing off-chain assets, real world assets, as some people call them, on chain, you have to trust whatever system there is that says those real world assets are actually there and being represented on chain. So, if you were to bring a mortgage on chain, or if you tokenize a stock, or a stable coin, which is a tokenized dollar, you need some system that ensures that whatever is being tokenized really does exist as they say. And there's different ways that you would build that system depending on what is the asset that is being represented on chain. But yeah, like a lot of things, junk in, junk out. So having that system, if you are tokenizing any asset, green or otherwise, is very important.
Interesting. Well, hopefully that answered. I think it certainly answered it as well as I could think in a few minutes. So good job, Brooke. The other question we have, which I think is a nice way to wrap up, and again, any one of you, feel free to answer, but out of all the different use cases we kind of talked about over the last hour, if you were going to pick one that was going to really have some sort of like widespread adoption in the near future, which one would you say it would be and why?
I'll go back to the example of daylight, which I provided earlier. The reason I'm choosing daylight is there are literally assets that just about anyone in the United States has in their home already. So almost anyone has a smart thermostat. More and more people are getting solar panels or home batteries. So, a lot of crypto networks that have been powerful have been ones that anyone can contribute to without having to necessarily go on to an exchange and buy the token. They can use something from their home, say a spare computer or otherwise, to get involved. So with both, with these distributed energy resources becoming more and more popular within the United States, my expectation is more people, learn about things like daylight. The opportunity to get involved will be, attractive enough because they already have these hardware assets, and will want to contribute them to the network and earn partial ownership of them moving forward. So yeah, big vote for daylight just because of the ease of getting started with it.
Yeah, I think that touches on some of the other things you guys were talking about earlier in terms of barriers and just like how people get involved in this stuff to begin with.
Yeah, I'll reference one that we're invested in as well. It's a company called Yellow Card. They use stablecoins for payments in Africa. So they allow you to do cross-border payments where you pay in your native currency, the person or the business on the other side receives whatever it is that their native currency is, and they're using stablecoins behind the scenes to move money cross-border in a very cost-efficient way. So it allows you to do cross-border payments and remittances, again, significantly cheaper and quicker than the existing methods for doing that in those countries. So it's, I mean, stablecoins more broadly, are a huge industry. You're doing, a couple trillion of transaction volume in stablecoins per quarter. So it's a category that has a very large existing product market fit and is already a large market. But that's one specific company that is using stablecoins to, provide a significantly better offering and saving its users a lot of money versus the existing financial services offerings.
Interesting. Yeah. I don't think that's one that I had come top of mind for me, but it makes a lot of sense. All right. If that is it, we have 3 minutes left, but I'm happy to let the audience have a couple more minutes in their break for the executive chat. So I'll just thank the 3 of you again very much for being here. I found it extremely fascinating, and hopefully you've got something out of it as well. Anyway, yeah, time for another 15-minute break, and we'll be back with our executive chat. Thank you.
Thanks, Nicole.
Yeah, thanks everyone so much. Appreciate it.
Is my mic working?
Yes. Hello, Charlie. Thank you for testing it. The mic is great and your Video is great too.
Great. Talk in a few minutes.
Thank you for the test. Yes. Bye-bye.
All right, looks like we are just at the 11:15 mark. So time to start the final portion of our hub today, the executive chat, where we will explore a little bit more about the regulatory framework that all of these industry developments are taking place. So first, let me introduce TK Keen. TK was appointed as Administrator of the Oregon Division of Financial Regulation and Deputy Insurance Commissioner in December 2020. Prior to his appointment, DK was a Deputy Administrator with DFR. Before joining the division, he practiced law as a sole practitioner in Washington, focusing on employment law cases. During law school at Lewis and Clark College in Portland, he worked for the Oregon Department of Justice, the Honorable Elizabeth L. Paris of the U.S. Bankruptcy Court, and the Portland State University Office of General Counsel. TK has led and participated in several model law workshops to shape national consumer protection policy with the National Association of Insurance Commissioners, Conference of State Bank Supervisors, and Money Transmitter Regulators Association. Welcome, TK. And then we have Charlie Clark. Charlie was appointed Director of the Washington State Department of Financial Institutions, DFI, in April 2019. He first joined DFI in 2012 and served in the roles of Division of Consumer Services Enforcement Program Manager and Division Director before serving as Agency Deputy Director beginning in November 2016. Prior to joining the DFI, Charlie represented DFI as its lead litigation counsel and Assistant Attorney General from 2005 through 2011. Prior to joining the AG's office, he worked as an attorney in private practice. Charlie sat on the board of directors for the American Association of Residential Mortgage Regulators from 2014 to 2023 and served as president from 2018 to 2020. He also currently sits on the board of directors and serves as chair of the Conference of State Bank Supervisors, having previously served as secretary, treasurer, vice president, and chair-elect. Charlie received his undergraduate degree in accounting and master's of business administration from the California State University, Sacramento. He received a JD degree from the University of Pacific McGeorge School of Law. Thank you both for being here. I'm thrilled to have you and that you guys have such long, impressive resumes, and also thrilled that I am done reading them. So with that, I will let you two take it from here.
Great. Thank you so much, Nicole, for reading that, and I'll attempt to get you a shorter bio in the future. So thank you, everybody, for being here, and Charlie, you as well, being willing to be part of this panel. Just a really important policy conversation about investments in both of our states and understanding what we both do on a day-to-day basis, whether it's running the licensing and registration of investment professionals or outlining what each state's respective policies are, or even being part of the national conversation and being able to be influential in those spaces. Just very key to what we do. But I have to say, green finance is a bit different. It's a much broader policy issue that has the attention not only of investors and investment professionals, but also, legislators, governors' offices, and our federal counterparts. And so in this space, it's a little different, and it's an evolving space too. And so it's certainly exciting to be able to jump into policy issues as it relates to this subject matter, but it is also a little bit outside the norm, I think, for both of us. And so just wanting to hear maybe, Charlie, from you on what you think the role of regulators is in this space and dealing with these policy issues.
Sure. Well, first of all, good morning, everyone. And Nicole, thank you for the introduction. Thank you and TK for the invitation to join everyone today. I've really enjoyed the discussion. It's been super valuable to hear all the important insights. But getting back to your question on what's the role of the regulator in this space. So I would, if I kind of distilled it down, my biggest priority, I think, is to create a friendly regulatory environment. That means creating regulations that carry out the goals that are set by our legislatures, whether it's in your state, Oregon, or in Washington State, and making sure that the framework achieves a few basic things. First of all, it has to be relatively easy to understand. It has to be protective of consumers and businesses alike, and not be unduly burdensome. And so those are pretty lofty goals. This is not an easy task, especially, when we talked or heard this morning that, these industries that we're dealing with are interstate, but also international. So that makes it really complicated and difficult to achieve those goals. I would say that we also have to be wary of stepping outside of the legal parameters set by our legislatures and the courts, and encouraging the development of green finance, especially in the private sector. We have to be careful and support a robust regulatory framework, but we can't step beyond our fundamental role as a regulator.
Excellent. Thanks, Charlie. And maybe could you elaborate a bit on that last point? What sort of topics do you feel like are kind of inbounds for regulators versus what's more the domain of legislators?
Sure. Well, I think that is the easiest way to think about it is that we're regulators, we're not legislators. So there is one kind of current example of this tension, and it's emerging in the debate around how we regulate corporate governance. So by way of background, corporate governance refers to the systems, principles, and processes by which companies are directed and controlled. So corporate governance sets the framework for how a corporation operates and makes their decisions. It also plays a critical role in ensuring accountability and transparency within organizations. And strong corporate governance really helps mitigate some of the risks. It protects shareholder interests and it fosters trust. So why is corporate governance important in the context of green finance? Well, with the rise of the importance of social responsibility and sustainability, stakeholders have been increasingly looking to companies to not only generate profits, but contribute positively to society. And so they've been asking regulators, and I know Kirsten mentioned that she sometimes gets these requests. They've been asking regulators to mandate certain sustainable business practices. And regulators have been listening. So a few years ago, the European Union adopted a sustainable corporate governance initiative. And the initiative gained global attention, partly because one reform option was to require company directors to take into account all stakeholders' interests, which are relevant to the long-term sustainability of the firm, or which belong to those affected by it. So taking into account employees, the environment, other stakeholders affected by the business as part of their duty of care to promote the interests of the company and pursue its objectives. So this was really controversial because historically a corporation has operated to the benefit of the shareholders. And so if you take that background and you fast forward to last year, the FDIC proposed a new corporate governance framework here in the US that kind of echoed that EU initiative. The FDIC's proposed guidelines would establish new stakeholder duties for the boards of covered banks, and those guidelines would require that the board consider the interests of all stakeholders, similar to the EU, including shareholders, depositors, creditors, customers, regulators, and the public. Uh, and this concept really, doesn't sound bad at first blush. I understand kind of the impulse of the FDIC, why they wanted to take into account these other stakeholders. Why not make companies consider these broader societal duties? And so I think there was a good motivation to kind of look at this issue. But it really turns out that our corporate governance law has historically been rooted in state law, which creates a fiduciary duty to the corporation and the shareholders. And so there's kind of a conflict if you expand that beyond that basic duty. So I mention this again because this is a situation where an agency has proposed a regulatory framework that conflicts with the existing underlying laws. And in this case, the FDIC did it without a congressional mandate. So that's a long-winded example of where that's occurred.
Yeah, that's excellent. Thanks, Charlie. I know when the FDIC guidance came through or the proposed regulations, and you had a key role with the Conference of State Bank Supervisors, or CSBS. I'm wondering if you might be able to tell us a little bit about your position at CSBS at that time and kind of how that conversation went with your fellow regulators during that time period.
Sure. Well, the proposal came out in October of 2023. I was the chair-elect of the Conference of State Bank Supervisors. I became chair in May of 2024. And just to give the audience a little background, the Conference of State Bank Supervisors, or CSBS, is a national organization. All of us state bank commissioners or directors or supervisors, our agencies belong to it. And it really kind of advocates for the state financial regulator, financial banking regulatory agencies. So I at the time I was a chair-elect of CSBS, the FDIC's proposal was released, and we really scrutinized it and gave it a good bit of time to analyze it and looked at the framework and the potential risks. And we ended up submitting a comment letter stating that the FDIC should withdraw the proposal in its entirety for many reasons, including that the corporate governance laws or standard proposed would conflict with established underlying state law. So that was our primary concern with the FDIC's proposal. And so, to be clear though, as I stated previously, there's absolutely a regulatory role here. We should be trying to create that hospitable or friendly regulatory environment. We just had two panels that discussed some of the industry's challenges, whether it was AI or blockchain. We need to look at how we can help overcome some of those challenges. So TK, how do you think we're doing in addressing the concerns that were discussed this morning?
Yeah, I think we're doing okay, but I would say, based on the prior panel's conversation, it's really clear there are some challenges from the regulator's seat. Right now, we've got robust sets of laws that I would consider to be fairly generalized around investment professionals. And so knowing that, it's kind of created, I think, perhaps some gaps, or at least some areas where more guidance would be welcome, whether it's at the federal level or the state level. And I think, the whole idea of kind of trying to carve out what this landscape looks like by enforcement action is really tricky and leads to uncertainty, which is the opposite of what you and I try to create every day for our investment community. So yeah, I think there's just room likely for more thought and more guidance from the regulatory community as we get into some of these issues, particularly around green finance. But I think there are some real challenges that we have, and one of them is, we don't know what we don't know, right? So if someone doesn't bring us the problem, if they don't bring us, this was the attempt or the pitch I received, or this is the information they said that they were going to go do around ESG issues. We don't have a way to really get into the conversation without consumers bringing us those sorts of pieces of information. And so that's been a challenge because, we are responding to what consumers bring us, but we know that there's a lot more out there. And the second is, a lot of these terms, whether it's a green loan or green credit card or green investment, not absolutely clear what all that entails at the general level, absent some sort of standards around it. And what might be a green investment or a green loan in one person's eyes may not be that in another person's eyes. And so I know New York and California have both made attempts to, really put some standards in place around these ideas, whether it's the Voluntary Carbon Market Disclosures Act or, Climate Accountability Acts. But I think it's going to be hard for just one of our states to do it on our own, particularly given the worldwide impacts and how this green conversation has evolved. So, I know SEC has its climate disclosure rules, which have been controversial and have had to be paused here to um, really kind of take stock as to next steps. So, knowing all of this in terms of how the conversation's quickly evolving, um, it seems like, state and federal regulators are really focused on disclosure and wondering if you see disclosure as the next obvious step here.
I do. I think there are definitely some major benefits that can be achieved from disclosure. Perhaps the most obvious is improved accountability. When stakeholders can more easily verify claims, companies will be less likely to engage in greenwashing, we heard that earlier, or other misleading practices. I think disclosures provide important information for investors. By analyzing ESG disclosures, investors can better assess potential risks, including regulatory changes, supply chain vulnerabilities, and environmental impacts. I think disclosures can also help companies engage in better risk management practices. For example, disclosures can help companies recognize ESG related risks, whether it's climate change impacts or labor practices, and hopefully they can adjust their practices early and develop strategies to help mitigate some of those risks. But I think there are limitations here too. So one is our technological ability to gather data we need. So we can tell a company to tell us how much carbon they're preventing from entering the atmosphere. We can even tell them to tell us exactly how they're measuring it, but there may be limitations on the company's ability to accurately report that, and our ability to spot when it's inaccurate. So some challenges there. And this might be one area where tools like AI and blockchain could be useful down the road to improve in this area. So the other limitation is on government capacity. So, you mentioned initiatives coming from the federal government, California, New York, and not only do they regulate most of the largest financial institutions, but they also have capacity to implement some of these new programs at maybe levels that smaller states like Oregon and Washington may be a little more hesitant to jump into.
Got it. Hearing from the prior panels today, another aspect to this is certainly the supply chain. And I know Washington and some other states have looked at supply chain issues as well, including introducing legislation aimed at transparency of the supply chain. Do you see that as another potential starting point here?
Sure, I think so. We have seen laws aimed more specifically at supply chains. Dodd-Frank has some provisions regarding supply chain transparency. California passed the California Transparency and Supply Chains Act, as you mentioned, and Washington introduced a similar bill. It was not passed though. And the bill in Washington would have required manufacturers doing business in Washington who have annual worldwide gross receipts of $100 million or more to disclose its efforts to eradicate human trafficking and forced labor from its direct supply chain for tangible goods offered for sale. So again, these bills, so far at least, are aimed primarily at combating concerns like human trafficking, but there's an obvious jump to sustainable supply chains as well.
Yeah, and another angle is how you look at public funds, right? So at least it's treated differently than the private sector, so that at least legislation could touch on those things a bit more. So whether you're talking about what a given state's treasury investments may be, or what's in their portfolio around ESG issues, or state retirement accounts and pension funds. I mean, there are ways that you can put parameters around the public sector that you can't as easily do, perhaps in the private sector, as the FDIC has done or is trying to do.
Sure. Yeah, and I would say Washington has some similar initiatives for similar reasons. While Washington has had several bills introduced to promote social or green investments, none of them have been able to pass the legislature yet. But on looking at our state investment board, they have developed some guidelines to look at ESG factors and incorporate that into the investment strategy. So I think the other piece of this for state level agencies in terms of what we can do and are relatively well positioned for is investor education. So TK, how do you view your role of investor education in potentially making this sector safer?
Yeah, it's a great train of thought there in terms of what we do day in and day out. So yeah, I think it's vitally important that consumers are kept informed on consumers/investors kept informed on what exactly they're investing in, how they're investing in it, and what it means. And I thought the prior panels did an excellent job of breaking down some really complicated issues, but it also was pretty clear that these issues are complicated, and trying to explain to lay people like how some of these investment opportunities work is difficult. And so I think what we have seen, and as we're looking at the mix of items that come to our office, are really opportunities in what are called solar scams, which is, different ways of putting forward, um, opportunities where solar panels may be part of it, or what you can do around solar power that present themselves as being affiliated with a government or a utility or a business, misrepresenting what is actually happening with the scope or scale of the improvements that they're proposing to do, and the savings that are ultimately received by that end consumer. There are also business opportunities billed as sustainable, sometimes facilitated by innovative technologies that scammers know consumers are not going to understand, that have turned out to be fraudulent. And just as one example, on the federal side, we saw a case against a crypto company that the investors were told it was a so-called green box opportunity. It was pretty specialized, and there was supposedly taking place the mining of green tokens that were on a green blockchain. And these are all allegedly claims supported by a public global decentralized power grid that could generate 40 to 50% in monthly returns. And it was just a multi-level marketing scheme. So it's just, kind of gives you some flavor as to how people are taking what's a hot topic in public policy circles and turning it into a scam or an investment fraud that can be perpetrated, to any consumer out there. So we've taken, a lot of steps here in Oregon to nip this in the bud, along with other financial fraud and scams that we commonly hear about. We've hired a new manager to oversee our consumer education unit, Carla Martinez, who's focused on increasing our event participation and reviewing our materials to make sure that they're matching up with the very latest in terms of the scams that we see. For the first time in our division's history, we made it out to all 36 counties 2023, and have done the same in 2024. So just making sure that, our message is getting to not just the most populated areas or the I-5 corridor, but really expanding out to the eastern and southern parts of the state where historically we hadn't had as much presence. Participated, most recently in 3 Scam Jam events with the AARP and Oregon DOJ, and those have had over 100 participants each. And so, people are very interested in this subject matter and how to best protect themselves. And at those Scam Jam events, we have the opportunity to talk about fraud prevention, the most common scams that we see and the Oregon Department of Justice sees. And so just a great opportunity to share what we know. And we've also just this year updated the Oregon Investor Guide, which does a really good job of getting into strategies for your investment portfolio and how to best avoid fraud, and really puts it in layperson terms. So these are just a couple of the things we're doing in Oregon.
Well, it sounds like that's some great work going on in Oregon. And I would say in Washington State, we're doing a kind of a very similar effort. I think we've all been seeing that just fraud is coming from every direction. And the random texts, the emails, phone calls, spoofing, all that stuff. And so in Washington, just this summer, our Department of Financial Institutions launched a statewide advertising campaign. We called it 10 Billion Reasons, which reflects the estimated $10 billion Americans lost in 2023 to financial fraud. And that was according to the Federal Trade Commission. And so the goal of the campaign is really, and it's ongoing. So the goal is really to encourage people to learn how to identify, prevent, and report financial fraud. So we used all kinds of media channels. We had billboards on I-5 and over in Eastern Washington. We had ads in movie theaters, on movie screens. We did radio, streaming, social media, print media, online news sites, and our campaign reached over or had more than 2 million impressions on social media. We also stood up a separate anti-fraud website, which has been successful. On that, we'll issue consumer alerts if we hear of investment scams that just appear to be outright fraud. So those consumer alerts are really helpful. We also have a team that goes out. We have presentations with about 20,000 people a year. Our team does about 100 outside outreach events per year, where we'll address the presentation to groups of all ages. And so the last thing I would mention is we have a grant program where we provide grants to some nonprofit organizations to empower those community organizations to conduct financial education to underserved communities. So there's just so many ways we can put our resources out there and try and address this problem.
Well, thanks, Charlie. That's really commendable work as well, and good to hear. There's so much positive anti-fraud work being done up in your state. So maybe turning a little bit, how do you see balancing the risks and rewards of innovative technology? So, I mean, there's no question things are moving faster than we've ever seen before. Like we talked about, or prior panels talked about, you got blockchain, you got AI, you've got ESG, you got green finance, all kinds of different proposals coming at consumers. But at the same time, I mean, those innovative technologies are very valuable and are being used by at least in terms of AI and blockchain by some of the biggest corporations in the world, and have become part of our day-to-day life in a very short amount of time. So there's definitely some opportunities for this new technology to be able to present a societal good and really make progress on the green initiatives that we care about. So how do you see the regulators balancing the risks and rewards of new technology, and how do you generally think about that?
Well, my thoughts on this are along the same lines that you mentioned, that just the pace of technology is so fast, and it almost makes it tough to really assess the risk versus reward. I absolutely see the rewards and the potential. But one thing that we're seeing is that I think regulatory agencies are somewhat strained by just the pace of innovation. By the time regulators start to assess new technology, companies may have already iterated several times and come up with kind of a slightly different model that's sometimes reaching different customers. Just the complexity of some of the modern technology and fintech can also kind of complicate regulatory efforts. So I think that's all something that we're really watching closely. I would say, our team has to have specialized knowledge of this, and we might talk about education a little later. But that's one of the challenges here too. And if we kind of overregulate as to one type of technology without considering the interdependencies, that can lead to kind of counterproductive outcomes, and that's something that I'm concerned about. So, you know, we kind of need a really nuanced understanding of our approach to regulation and the technology. So all of this is really a kind of a moving target, and you know, the market's changing. Consumer behavior is also driven by technology and innovation, and can also kind of sometimes catch regulators off guard as preferences shift away from one area to a new product or service. So what about you? What are you seeing as some of the challenges here?
Yeah, Charlie, I would agree with everything that you said. I do think, you know, a couple other thoughts. Yeah, the global nature of all of this really takes it out of our hands to a degree. I mean, I think, you know, Oregon's not going to likely be able to set forward a successful policy, kind of given all of the different states and countries that that these entities are engaging in, right? And I mean, I could tell it was pretty palpable, like the frustration by some of the prior panelists that we have to deal with, you know, so many different regulators and so many different standards, and so the compliance cost aspect is real. I think that could be a hindrance. You know, another is just resources, and you hit on this with the training piece. But I think, you know, the idea that, you know, we've got a lot of people who can easily go and delve into all of the investment proposals or all of the activities that someone may be doing in the name of green finance is, you know, unfortunately a myth. I mean, we're very much a complaint-driven agency, and so we're staffed that way, and you know, it's very difficult to get additional positions to make a shift there, where you go from being an agency that's complaint driven to maybe surveillance driven. I wouldn't say it's impossible, but it's just a very costly sort of endeavor. Um, you know, all that being said, you know, I think the points you hit on were exactly what I had in mind. And it really, the speed of development is a big issue here. And it means regulators are left with some difficult choices. You know, we can, in this universe, act with incomplete information. And that runs the risk of poor regulation and can hinder industry, and possibly create some consumer harms. Or the other is you basically have to wait till the very end of whatever the opportunity is, or get to a state of complete knowledge, which is very rarely possible. And that runs the risk of allowing industry to go outside of a regulatory parameter. Which, you know, could even invoke more consumer harm. And so it's really tough to strike a balance, I think.
Yeah, I agree. I think the other question here is, what's the best regulatory approach? Do we regulate by use case? For example, investment advisors using AI to make sustainable investment choices for their customers? Or do we kind of draw a broader brush and impose regulations on the technology itself?
Yeah, it's hard to know what the right move is. There's probably room in the conversation for both approaches, at least until we can get some more concrete guidance at the federal level, or, you know, there becomes a critical mass of states that all pull this one direction. You know, we've approached this with 20 plus programs as, you know, just trying to uh, be respectful of what each independent discipline, whether it's banks, credit unions, insurance, like how they might approach and regulate in this space. And they're all a little bit different. And so that, you know, pulls us, I guess, towards a more generalized approach, to the extent that we're not just dealing with a one-off situation or something that's been reported to our office that's a you know, a direct fraud that we're responding to in some way. But I think there are trade-offs in terms of, how fast do you get involved, and what sorts of regulations then do you put forward? Um, More applicable, I think, is, we're getting into some areas where there's going to be regulation of AI, probably greater regulation of blockchain, and one that was mentioned in the prior panel on consumer privacy. And so I think all of those got that kind of grouping of policy concepts will perhaps provide some guidance to all of us as to know what the next step forward should be in that regulatory space. Um, just curious, knowing what we're seeing in Oregon and some of the resource challenges we've had, like, how have you been thinking about educating staff on innovative technologies in your department?
Sure. Well, I would say it's challenging on a number of fronts. And, just to kind of rattle off a few of those challenges, we have time constraints. We want to make sure that we take care of all of the operational responsibilities, and with so much change in the huge need for training, we have to make time for keeping our staff trained, and so I think the other part of this that you mentioned is resource limitations. I think it's particularly challenging when the staff that you don't have folks that some of your folks may not be able to conduct that training, so you have to outsource it and look for opportunities there. And so the other thing is you can kind of get training fatigue, where it's coming so fast, you've got so much training that there seems to be just it can only be absorbed so quickly. And part of that, I think, is tied to the complexity of technology. I think some of these platforms are very complex, and especially for our examiners, that they have to go in and look at some of the operations. There's really a lot to that, and we need expertise in that area. So all those factors play into it, and then I think also just creating a culture where there's room for engagement and learning new things, and that has to come from the top down. And so I heard one of the prior speakers talk about how for AI to take hold, you have to create a culture where it's okay to use AI. I think in the regulatory environment, you have to kind of create a culture where it's okay and encouraged to learn this new tech, become an expert in it. And so those are my initial thoughts. I think all that being said, we do a pretty good job with training, and all of our divisions are very focused on technology, cybersecurity, and innovation. And we do quite a bit of internal training as well. So that's probably where I'd leave that.
Yeah, no, appreciate that, and think similar in Oregon, just looking for opportunities to partner with other states or our trade organizations at Conference of State Bank Supervisors and elsewhere, where we can, have those opportunities to bring people up to speed. Well, I see we're just about at time here, and just wanted to maybe just provide a high level comment of, there are challenges here, but from a policy perspective, anything we can do to forward green finance initiatives, and I've heard this from Charlie too. I mean, we're open, we're receptive to those, and thinking through with those externally, like what's happening in the space, and how we as regulators can help, while at the same time maintaining consumer protection. Charlie, any closing thoughts from you?
Oh, I completely agree. It's the discussion that's so important, and I appreciate that Oregon put on this event. I think it's really productive. So thanks for having me.
Excellent. Yeah, thanks, Charlie. Well, that concludes this particular panel. Nicole, I'll toss it back over to you for any closing remarks.
Great. Thank you both. That was a really interesting and insightful discussion. And in fact, thank you to all of our speakers and attendees for your participation here today. I know we covered a lot of ground over the last couple hours, and I'm sure that there'll be lots more to discuss in the coming years. A recording of today's event will be posted on the division's Innovation Hub website, so you can feel to go back and review anytime. And that website also allows you to reach out to the division at any time regarding any regulatory issues surrounding novel financial products. So just please know that we are here and we want to hear from you. With that, I will let you go. Thank you again for your participation and have a great rest of your day.